I love first gen in the house. I'm also first gen, of course. So definitely have that same perspective. And definitely it's about time for us to start talking about more than just that savings account. I love that, Darnisha. Absolutely love that comment. Okay, so let's jump in. So we're going to be talking about a lot of different things. But if you don't already know, a lot of the stuff that I'm talking about today is actually, I have some videos on my YouTube channel about it. If you're not already subscribed, definitely subscribe. I just post content, that I think are topics that we should talk more about that people don't. How I paid off my credit cards, how I improved my credit score, saving, budgeting methods that I use to get out of debt, all that kind of stuff. So if you're not already subscribed, the link is in the chat box. Go ahead and hit that sub button for me. And that's really where I kind of started showing people that, hey, I know a thing or two about money. I'm a little bit of an expert, okay? And I'm not afraid to show it, because I think a lot of times people are nervous to say, I know enough to talk about this or to teach people, but I kind of thought it was time to start teaching and telling people. So I started just YouTubing. But that being said, I am not a financial advisor. None of the things that I post on my channel, on my Instagram, or here in this presentation is financial advice. I'm not a licensed financial advisor, nor do I want to become a licensed financial advisor, because a lot of times financial advisors only work with people that have a certain net worth. Like if you have to have $250,000 or more, otherwise they won't even take a meeting with you. Right. And for me, that pretty much cuts off like everybody that I know, like my whole family, all my friends. Like, what? How am I going to help my community if I'm cutting them off from my services? So I don't really want to go that traditional route and like help wealthy people get wealthier. I really want to look out for my community and help average everyday people. So all of the information I'm presenting is really educational. It's informational purposes only. Kind of picture yourself sitting in my classroom and I'm teaching you. You're not in a bank with me in an office and I'm trying to sell you something. That is not what's happening here at all. All right, so jump into content. When people ask me about investing, especially for retirement, one of the big things that they ask is, how do I know if I'm ready to start? Where do I go? What do I do to just get started? And the first thing I tell people is you need to start with your why. You need to know, why is it that you are even investing in the first place? If you can't start there, your whole investing journey is starting off on the wrong foot, because you don't have that foundation in place. When things get rough, when you're confused, when you're frustrated, you have to go back to that why. So you need to start with that first step. Now this week, if you guys follow me on Instagram, this whole week, I've been doing, what do you want to do when you retire? What do you picture your life to look like? And that for me, it's like, that's my why. I imagine myself traveling. I imagine myself volunteering. I need to have money coming in if I want to volunteer my time, because I need to pay my bills. I need to be able to pay for, flights and, cruises or whatever I want to do. I don't want to have to be forcing myself to work sometime so that I can make the money that I need to live. So imagining that life is my why. It's like, I want to have the freedom, I want to have the independence, and I want to live my life on my terms and not have to report to work, at an older age, unless I feel like it. Like if I want to go and work part-time or do something, then I'll do it. But it's because I want to, not because I have to. So that's really my why. And for me, that comes from seeing my parents. Like my dad had to work through his 70s. He just got a chance to retire a couple of years ago in his 70s, when most people, tend to retire, 65 is usually 62, maybe. He had to keep working like another extra 10 years because he just wasn't prepared financially. So I really want to prevent that. That's kind of like my why and my North Star. And then the next question, once you have your why, is, do you know the difference between investing pre-tax and after tax? Because when it comes to investing, especially for retirement, is like married to taxes. Investing in taxes is like café con leche, coffee and milk. Like it goes together. They're married. You cannot separate them. You can't talk about investing without talking about taxes. So you have to understand that very basic pre-tax or after tax. I'm going to talk about that today. And then the last question is, do you know what you want to invest in? And actually, shout out to Derek. I don't know if he's here already yet, but he emailed me a list of questions before the session. And one of them is like, all right, how do you know what to invest in? So he's already thinking about that, which I love. So shout out to you, Derek. All right, so let's jump in. Here is a quick chart that shows you why you need to be investing. And in the chat box, I already saw a bunch of people mention it, that we need to be investing because the savings account is not going to cut it. So here is a comparison from 2015, which is when I started my financial journey, because that's when I paid off all my debt. That's when I really started paying attention to like the rates that I'm getting on my investment account, on my savings account, right? And for me, that was the realization that happened there was, you're going to grow your money way more when you invest it than when you put in a savings account. And this simple little T chart gives you that comparison, right? In 2015, the highest amount of interest that you were going to collect from a savings account, and I put here APY, which stands for annual percentage yield. So that's the percentage that you're going to be able to expect that you get from interest payments in a savings account. And the type of savings account that I chose is the one where you get the most interest. So that's a HISA, what people call for short, which is high yield savings account. So instead of going to like a traditional bank, Bank of America or Chase Bank, where they give you, 0.01% interest, it's better to go to a high yield savings account where you can get a lot more interest than that. So a lot of times those are going to be online, but there are some brick and mortar banks, like physical banks, that do offer high yield savings accounts. Regardless of where you open it, the fact that it has a higher yield, you think, oh, you're getting more money. But then when you compare it to the average of the 500 companies that are leading the stock market growth, which is called S&P 500, and we're going to get into that in a second. So if you're like, I don't know what that means, don't worry about it. You're going to know by the end of the workshop. So if you compare those, basically the stock market to a savings account, you can see the savings account misses the mark almost every time. So in 2015, 1 versus 1.38, pretty close, right? The stock market didn't have the best year ever. But then the very next year in 2016, high yield savings accounts were still right at about 1%, whereas the stock market was above 11%. In 2017, the stock market above 20%. Well, not the savings account, still at around 1%, a little bit more, 1.25%. So if you are in a position where you don't need a lump sum of money that you have built up, whether it's in your savings account, whether it's, money that you're earning, that you have extra after, you pay all your bills and you're like, oh, I have this extra money. And usually you would just spend it, but you could actually invest it. Then instead of keeping it in a savings account, it's clear that putting it in an investment account is going to allow it to grow way more, because the average of all these rates between 2015 and 2021, which was just the end of last year, 1.31 on average for a savings account at a high yield, which is, that's like a lot in the banking industry, versus 15.46% on average in an investment account. This is huge. This is a huge difference. And, we have to be paying attention to these rates, because this is essentially how fast your money is growing. Why would you lock in your money growing at 1.31% when you can go for that 15.46%? Now, it sounds great, but there's some risk associated with the stock market. There is the risk, like in 2018, high yield savings accounts were giving 2%. The stock market had negative 4.23%, which means if you started 2018 with $100 in your investment account, you saw a drop of negative $4.23. Every $100 that you had in your investment account in 2018, by the end of the year, lost $4.23 for every 100. And that's the risk that you take, because the stock market can go up, but it can also go down, which means you can make a lot of money, but you can also lose money at times. But the longer you stay committed to the stock market, the more you're going to ride those waves, and it's going to even out. It's going to average out. So you can see something realistic, like instead of 20% or negative 4%, you'll see something more in the average around 15%. Now, historically, the average is actually like 9%, 8, 9, 10% is a fair number. But in this case, throughout these specific years, we see a 15% average. And that's looking at starting in 2015 and continuing through 2021. So like a really recent example. All right, we got New York City in the house. That's what's up. I love seeing my home city here. I'm based in Miami, you all, for those of you who didn't know, but I'm originally from Brooklyn. So of course, New York City always gets my love, always. Okay, so now when it comes to investing, we understand the importance. We know that the savings account is not going to cut it, but we have this big decision to make, which is how to start investing. You can actually open an investment account and start selecting individual stocks, like, oh, I really like this company. I like that company. Oh, this stock is hot. Let me buy that. But it's really hard to know, because there's thousands of companies in the stock market in America alone, let alone Japan, London, Tokyo, all the other stock markets in the world. If you want to have global investments, it gets even harder, because now you got even more choices. How to know which ones are actually going to do well this year can be really tricky. And it takes a lot of time if you want to be good at analyzing and looking for valued companies that maybe are undervalued and maybe you'll have potential for growth. You got to dedicate a lot of time to that kind of work. And it's something that you really have to specialize in. Not only that, but it's very risky, because no matter how many projections you make for a company to do really well, and you're thinking this is going to be the one, this one's going to make so much money, you have no idea if they're going to have a scandal in the media, if something's going to happen where they're going to lose money. You don't know if the value of their stock is going to drop just because somebody tweeted something, or because, we've seen examples of this a lot. A couple of years ago, Kylie Jenner tweeted that Snapchat was dead. Snap stock dropped. literally the like 10 minutes after she tweeted that, boom, stock price dropped. What Snapchat, the company, has no control over what Kylie Jenner tweets or anybody else for that matter. So there's so many external factors that you might not be considering when you're projecting which companies are going to do the best. So when people tell me, oh, I do technical analysis and I know which stocks, I'm like, okay, your technical analysis does not consider all the emotional factors and all the ridiculous stuff happening on social media. There's no way to account for that. Those are not numbers. Those are emotions and ridiculous events, right? So we have to always make sure we make room for that. Like, you know, the unforeseeable, the anything is possible kind of part of investing and companies. The second option is, instead of going that route, like individual stocks is really risky, I don't know what stocks to pick, that's a lot of work. Well, you can buy mutual funds or ETFs, or you can hire a financial advisor. Now, if you're very, very wealthy, you know, your net worth is above $500,000 or even $250,000, and you're like, I have a lot of money, but I don't have a lot of time, and I don't mind paying extra money, like giving some of my money away to somebody to just handle it for me, then that would be a good candidate for a financial advisor. Somebody who has a lot of money, they don't mind giving away some of that money to fees and to paying that person to do the job. And also, you know, they don't have time really to dedicate to just even taking 15 minutes, because literally it just takes 15 minutes to set up your account. If they don't have that time, then they could hire a financial advisor, and financial advisor will take some of their profits. So it's really important to keep in mind the average everyday person, we're not going to really necessarily be able to work with financial advisors unless we have access to a special program, either through your job, through your specific retirement account, or if the institution that you're investing with has a special program to allow you to meet with an advisor. But they're generally not free. They can cost a lot. And for the average everyday person, most of the time, you don't even have enough money to meet their income threshold or their net worth threshold for them to even sit and talk to you. Like, oh, you got baby money, you don't have $500,000. Yeah, we don't meet with clients that don't have that much money. It's like, well, okay then. So for most average everyday people, the option that's circled in the middle is going to be the best, which is buying mutual funds or ETFs. That's going to be the most appropriate, no matter who you are, how much you make. If you're an average, everyday, regular person living your life, trying to impact the world and do your part, this is going to be the easiest, quickest, and probably most appropriate route for you that won't cost you an arm and a leg. It won't take a ton of time. And it's also really savvy in terms of all the strategies for investing being included in that one package. So we're going to start with that, and then we're going to get to IRAs. So if you're like, wait, this is an IRA boot camp, why is she talking about mutual funds? It's going to come back around when we get to the IRAs, because you have to pick investments in an IRA. So you do have to know a bit about mutual funds and index funds and ETFs first. All right, so Tyrone, great question in the chat. Do you have an idea of how much financial advisors charge? The way most financial advisors work, most of them are going to work on a percentage fee. So that means that they will charge you, 1% of your assets under management. So if they are managing, $100,000 for you this year, they're going to take 1% of that. So they're going to essentially, each year that you make more money, that percentage grows. Because if next year, if your money grows from 100 to 150,000, 1% of 150,000 is more than 1% of 100,000. And when you make $1 million, $500,000, $2 million in your retirement, they're still going to continue to collect that percentage. So the money they make is more and more every year, the more your account grows every year. It's not like when you work with like a personal trainer, for example, where you meet with them and they tell you $100 a session. Every time you meet, it's $100 a session. Not for financial advising. Every year, the dollar amount that you spend on them is going to increase because it's a percentage of your assets. So they know how to build in increasing income for themselves while they work with you. That's why a lot of financial advisors for the past 10, 20, 30, 40 years have been making lots and lots of money, because the more the accounts grow, the more they're able to collect more dollars because of that percentage fee. So usually they're, depends on where you go. Some of them are 1%, some charge a little less or some a little more. But that's, fairly standard, is that they'll take a percentage of your assets. Some financial advisors now, which is amazing, are changing that model, and they're going fee-based, kind of like a personal trainer. They're like, listen, when you meet with me, you pay my flat fee. And I don't keep taking from your account when it grows. I let you benefit from that. That is your money that you put in there to grow. So I take a flat fee from my work, and that's it. So that would be, a flat rate. That to me, I feel like is a bit more ethical, but that's my personal opinion. Everybody doesn't have to agree with that. A lot of people go, no, it's fine. It's ethical for them to take a percentage. You know, it's kind of like royalties with music. Like if you play my song 100 times, I need to get paid every time, not just the first time. So it's up to you, your personal opinion with how you feel about the way they structure their fees, but it's either going to be a percentage of your assets under management or a flat fee. All right, so let's jump into why is it that mutual funds and ETFs and index funds are the thing that I said should be the average everyday person's approach. Is because of this one word, which is diversification. When you're investing, you don't want to put all your money into one stock or two stocks or even 3 or 5 or even 10. You might think 10 stocks is a lot, but that's actually a really tiny portfolio with almost no diversification, right? Because there's thousands of stocks in the US alone. So how in the world can you think that 10 out of the thousands are going to be the ones that you like? There's no way for you to know if those are going to be the ones to do well. So it's really important to try to diversify. Diversifying means you have as many companies across as many industries or sectors as you can that have lots of different types of company business models, because you don't want to just rely on one. So in this example, low diversification is just having one stock. That's actually pretty much no diversification. It's just one stock. That's little to no diversification, which means you have a lot of risk, because if that one company stock doesn't do well, all the money in your account is dedicated to that one company, and you're going to see your account balance go down a lot. So getting a little bit more diversified, let's say you have a sector fund. A sector fund means that all the companies in that fund that you're investing in, which is pretty much like a bundle with a lot of stocks in one basket. So instead of buying like one roll of toilet paper at a time every time you go to CVS, like just buy a pack of 36, right? That's a fund. It's just getting them all at once with one click of a button to buy one time, instead of having to keep buying to get all the stocks. So if you buy the fund and it has all these companies and there's 50 of them, if they all come from the same industry, like say technology, then that's a tech sector fund. And that is, at about 50 companies. It depends on the tech sector fund or the specific fund you're looking at, but about 50 companies, which is better than having one company or 10 companies, but it's still only a tiny little fraction of the number of companies available in America, let alone globally. So it's better to have, an average mutual fund or index fund or ETF fund where you have about 100 stocks on average. That's the average. Some is a little less, like 90, some is more, but the average is that. So to me, I would tell people the minimum amount of stocks in your portfolio should at least be in the hundreds, right? Because you got to really make sure you represent as many industries, as many, sectors as you can. Because if one sector is not doing well, other sectors might be doing better at that time. So then you have a little bit of balance in your portfolio, right? Rather than depending all on one sector and they might be not doing so well, which means your portfolio is going to take a hit. The most highest possible level of diversification that you can have in the US in terms of only investing in the United States is a total stock market fund, which means every single company that the public can buy on a stock exchange is going to be included in your fund, in your basket. So you will have over 4,000 companies by just clicking one button and buying a share of a stock market fund. So this diversification scale, the closer you are to high diversification, the less risk you're taking, which means that you're spreading your money out through a lot of sectors, industries, and companies, and giving yourself a better chance to succeed rather than taking a hit if one industry doesn't do well. All right, so what exactly does it look like to invest in a fund, or how does it work? Well, you put your money in and a bunch of other people are also putting money in, right? There's all these investors who are also buying shares of the same fund as you. So it goes into a giant pile of money, which is this invisible box here that we're seeing, right? This little clear box. All the money goes in there, in theory. Now, somebody has to manage that money. So that person is going to be the fund manager. It's not going to be you. If you want to manage your own, you would have to go and click each individual stock and buy the ones that you want and do that. That's a lot of work and takes a lot of time. So going through a mutual fund or an index fund or even an ETF is just going to make sure that a fund manager is going to make the decisions about which companies are in this group, when to buy, when to sell, what are they doing within that fund to try to grow the money that all the investors are putting into this giant pile. And the fund manager is going to decide what to do with it. Their goal is to make everybody money. Like their goal is to make the account value go up, right? The stocks inside of here, they want to make sure that the value of those stocks are going to go up over time, so that everybody who's investing, the investors of the fund, are happy, they're making money, and they don't, leave and sell their shares and go buy another fund, so that's their goal, is to do well for everybody so everybody can make money. However, they don't work for free. Just like financial advisors, like, they got to get paid. So we're going to talk about how these people get paid, because this is the number one thing you have to understand. In your IRA, in your 401k, any type of investment account, you're paying costs and fees, and you got to know what they are. So first things first, when mutual funds, which is like a very traditional way to buy a bunch of companies in a basket, they come with commissions. Nowadays, there's less and less commissions. A lot of them are no load funds, like zero commissions, which is great. But historically, that has not always been the case. So what is a commission? They don't call it a commission because they don't always want people to know like the language, because then it's like obvious that you're paying for, paying fees. So they sometimes will change the words. So instead of calling it a commission fee, they'll call it a sales load. And there's different types of sales loads: front end sales load, back end sales load, constant load, or no load. No load is obviously the best because it means that you're not paying any fees to do the same thing that somebody else is paying for. So if you can get the same service, the same investment, access to the stock market for free, go for it. Like, that means more of your money is staying in your account instead of being given away to somebody. So front end, they just take a percentage up front, usually like up to 5.75%, which is a lot. That's a very high fee. Back end, which means you don't know how much they're going to take until the end, until you sell, and then they take a percentage of your profits when you sell. And then constant load is, what the fees are, and they just come out regularly while you're holding that those shares of that fund. Again, best case scenario is a no load fund where they don't take commissions while you're investing. They just let all your money grow for you. Now, how do you know if there's commissions or sales loads? It's going to be listed on the fact sheet. Every time you're looking at a fund and you're like, oh, should I get this one? Should I get that one? You want to look at the costs and the fees, and you look for sales loads. If it says no load, amazing. And expense ratio is usually going to be, no matter what, they're usually going to charge some type of fee every year, which is the expense ratio. So what you want to do is look at that, because it's going to be a percentage. So it's a percentage of all the money in your account, just like the financial advisors charge that fee every year, but it should not be nearly as high. If a financial advisor is charging 1%, these should be like 0.1%. Generally speaking, the lower the fee, the expense ratio is, the closer to zero, the better it is for you, because of two reasons. One, you keep more of your money in your pocket, right, in your account, so it can grow instead of giving it away in fees. And two, if you look at any empirical study over the history of the stock market, every single study shows you that 8 to 9 times out of 10, an account that has a fund that has a close to zero expense ratio outperforms all the other funds that have higher expense ratios. So the lower the expense ratio, the higher the performance, the more money you make and you keep. And the reason why is because you're keeping more of the money for your profits instead of giving it away. And after taxes and after fees, you'll see what you're actually keeping. So the lower the expense ratio, the more you keep. And that tends to correlate with better performance because you don't have to give your money away. Great question, Tyrone. Why would an advisor take zero commission or no load? Well, because it's a great way to bring in new business. For example, last year, I think, or 2 years ago, Fidelity announced a 0% expense ratio on their index funds. And a bunch of people who would not have signed up for Fidelity went and signed up for Fidelity. Because whoa, that's a great offer. That's like an offer that you can't resist. So a lot of people will go and invest in those. Also, the commission is just on top of your rate. Like when you go to, I don't know, like give me a shoe store, like when you go to Aldo's to buy shoes, right? And you walk in and you're looking at the shoes, the person who comes to help you, they're trying to make a commission. They're paid a salary, right? Or their hourly wages. They're being paid for standing in the shoe store to help customers already. They're getting paid, whether they help you or not. But if they help you make a shoe sale, they help you pick a shoe and you buy it and you tell their name to the register, on top of their hourly wage, on top of what they get paid, they get a commission. So it's more money for them. So these funds managers are already making money from the management fees that come from the expense ratio and all the fees associated with the account. But they want more. Like the financial industry, greedy, want more money. So they charge commissions on top. They don't have to. It's just easy ways to make extra money. And the industry is starting to move away from that because people are starting to realize like they don't have to charge them. They're just raking in money. They're just taking commissions that they don't have. They're already making money from the management fee. So why are they charging extra? So more people are starting to run to lower funds or no load fund fees because they're knowing the research that it's better for your results and you save more of your money. All right, so what's in that percentage expense ratio? It's the contributions and the earnings of your investment. So all assets under management get charged that percentage once a year. And it includes marketing expenses so they can promote that fund and get new investors to pull more money into it. And also management fees, which get paid to fund managers and to the folks working there running that fund. So people are getting paid. Don't worry, if it's a no load fund, don't feel bad. Like they're getting paid. They just wanted more money. All right, so why does this matter? Well, because when you're looking at your IRA, you want to know how it's performing. You want to know how it's performing. You want to look at the performance, the results, the returns. But you cannot know that until you subtract the costs and fees, because you can't include the costs and fees in your returns. That's not accurate. They're going to take that fee. You're not keeping that. So if you're looking at your returns and it's not subtracting the costs and fees, you're getting the wrong idea. You think you're making more money than you are. So you have to always take that return rate, the percentage that you expect that you're going to get or that you actually got, if you're looking at the past, and you have to subtract the fees that you paid for that year. So this is super important, right? So returns minus your costs and fees that you pay, that percentage is your actual performance. That's what you will actually see grow in your account that you get to keep. So we're going to practice with one example that has no costs and no fees, like zero expense ratio, zero loads, nothing. Like you keep everything. And then we're going to look at a more realistic example where there actually is a fee, and we're going to see the difference. Okay. So let's go ahead and start with this example. I'm going to drop a link in the chat box and I want you to do the math with me. I'm like, when it comes to this stuff, I'm like a super nerd. So I love playing around with compound interest calculators online. This is one of the ones that I always use, and I just dropped the link in the chat box. It's the Money Chimp calculator. I absolutely love it. I want you to go ahead and click on that, and you're going to try this with me. So what you're going to do is, oh, whoops, let me see. I think I stopped sharing my screen. Where is my screen? Oh, there it is. Okay. So what you're going to do is you are going to click on that link, and it's going to open up the calculator like this. What you're going to do is enter the information from my slide here. So the current principal amount, how much are we investing? Let's say, somebody in our family passed away and left us an inheritance, or we just won the lottery, or for some reason we came across $100,000, right? So we're going to go ahead and pretend we just put this $100,000 into the market. So go ahead and type in 100,000 as the principal, the original amount that we put in. Now it says annual addition. We're not going to add anything. We just want to see how much this money will grow if we don't add not another dollar. So for adding new money, annual addition, 0. We're not adding anything. Now, how many years are we going to leave it to grow? We're going to leave it for 25 years. And we're going to assume that the average we're going to get every year. Now, again, remember, the actual average of the stock market goes up and down, but the average is about 8-9% historically, close to 10%. And it's getting higher, actually, the more close to now, the closer to 2021 you get, or 2022, the higher it is, more like 11, 12, 13%. But for the sake of this example, let's go with a low example. Let's go with 6% just to be, safe and conservative. So we're going to say 6% for 25 years. And we're going to leave it to compound one time annually. Remember, the fees come out once a year, the percentage, and your account compounds one time annually as well. So we're going to do one time, make additions at the start. At the end, doesn't matter. We're not making any additions, but we're going to leave it at the start. When you're ready, hit the calculate button. And I want you to see how much that money would grow to in 25 years. All right, I'm going to take a look at the chat box. When you have your answer, put it in the chat box for me so I can see how much does that $100,000 become in 25 years. Again, no fees, right? 0 commission, 0 load, 0 expense ratio. All right, Mary, Alex, Crystal, and Anna, nice. First 4 to answer, and they all got it right. $429,187 and a little bit of change. So that $100,000, that little blue bar that you see on the left of my slide, when you pay no costs, in 25 years, you're doing your working career, you're living your life, you're not even looking at your account, you're ignoring it, and it will more than quadruple So over $429,000 without you doing anything. And that's at a 6% rate, which is very low. The stock market generally does more than that. So by doing absolutely nothing, you just made $330,000 in profit. And you get to keep all of it because there was zero fees. So you're not paying anybody fees or commissions or any kind of expense ratios or anything like that. That's amazing. But again, that's only possible if you find a zero cost, zero expense ratio, zero sales loads, zero everything. And that's very rare today. Only like Fidelity kind of launched that. And I personally feel like that was to get people to come to them. I don't know how long they're going to actually keep that, because come on, you need to make money like somehow, even if it's a little bit. So I don't know how realistic it is to expect that, for the next 25 years, the fees are going to be zero on that account. But, at least right now, that is something people would like to take advantage of. So $100,000 was what we contributed. Now, when it comes to IRAs, the language is really important. Contribution means you put that money in. That's your deposits. They just changed the word from deposits to contributions. And earnings is another way to say profits. That's the growth that your account, the profits that you made, they call it earnings. So two new words here that we got to know: contributions, that's your deposits, and earnings is the profits that your money made. But now let's look at a realistic example. There's different types of funds. One where the fund manager is actively doing all the work. They're picking and choosing the stock. They're constantly buying and selling and trading, trying to make you as much money as possible. That's called active management. And that fund manager, on average, will charge close to 2%. That's crazy, but it happens every single day. I help teachers who look at their retirement accounts and they'll look and see 1.91, and they're like, and I'm like, you're paying 1.9% in fees? That is insane. Like I'm paying close to zero, and you're paying close to 2. That's not fair, right? But they don't understand why it's not fair. They're like, 2%? Oh, 2%? Like 2? I got 98% of my money I'm keeping. And I'm like, okay, but what you're not understanding is that they make 2% sound like a little bit, but the same way your earnings and your growth and your money grows and compounds over time in the stock market, the fees also compound. So it's not just a little 2% now, it grows over time the same way your money does. So we need to actually put this into the formula and see how it would affect our money. So what if everything stayed the same in our calculator? So go back to your calculator, $100,000, zero fees, years to grow is 25, 6%, but we're going to change one of those. We're going to change the fees from 0 to 2%, right? Because what happened is the 6% return that we're getting is now going to change. Because remember that slide that I showed you that says your performance, what you actually keep, is taking the return that you expect. So in our case, it's a 6% return, subtracting the fees, the cost that they take away. So we can't put 6% here because that's not true. We're not keeping 6%. We're giving away 2% in fees. So we have to subtract 2 from our returns in order to really see what money we keep after we pay the fees. So 6 minus 2 is 4. So don't put 6 minus 2 in there, put 4, do the math there. And then hit calculate. And I want you to see what happens when you have a 2% fee, which a lot of people think it doesn't sound like much. Oh, it's just 2%, 98% is mine. What happens to your $429,000 when you give away a little 2% in fees every year for 25 years? Boom, there we go in the chat box. Crystal said, whoa. Yes, Crystal. It goes from 429,187 down to almost half of that, 266,583. Anna said, that's crazy. Yes, Anna, that is crazy. It is insane. And not a lot of people realize that when you're sitting with an advisor or when you're sitting with a fund manager and they're trying to talk to you about this and tell you, oh, so I take a small fee, I take a 1%, I take a 1.5, I take a 0.7 or 2% fee. These numbers, they sound small to us and we don't know the lingo. So we're like, oh, okay, yeah, I guess you do got to get paid, right? No, it's insane to allow them to take your profit that you would have been having and cut it down into literally half, because now that green $330,000 of profit of your earnings is now only $166 of earnings, because they take $164,000 over the course of your 25 years, on top of the fact that you have to pay taxes, and inflation is also going to make your money go down a little bit. So it really hurts more than you could possibly imagine. So we got to do the math on these IRAs. When we're investing, we need to look at the fund fees in our IRAs. We need to pay attention to them. And that they don't call it fees, they call it expense ratio. And then you also want to look at loads. Those are the different words that we need to look for to know what we're paying, because they're just taking our money from us. We don't have to do this. We can lower our fees to close to zero. Now, the easiest way to lower your fees to close to zero is with index funds. Remember how I said the fund manager does active management and charges up to 2% for that kind of work? Well, the opposite of that is passive management, which means that you're not actively trying to buy and sell and try to get the best possible return in the market. All the research shows that when you buy and sell more, you make less money. You're doing too much. All the research shows that simple, hands off is the best in terms of returns over the long term and also fees. So when you take an index approach, there's no active fund manager actively trying to research and analyze and buy and sell and trade to make you more money. We get rid of that completely. And what we do is actually tie the fund to an index. Now, this is where we throw in some vocabulary and people be like, well, what she said, index, what is that? So when it comes to investing, the easiest way to understand index is a textbook. So when you open a textbook, like old school textbooks, you flip to the back and there's an index. That index is literally just a list, and it tells you every topic in that book and the page that you can find that topic, right? So another word for index is list. It's literally a list with all the companies on the list. If they meet the criteria, they meet the qualifications to be on that list. So each list, each index has a certain, rule that you need to be able to get in, right? Like honor roll. Like you have to have a 95 average if you want to make the honor roll. If you don't have that, can be on the honor roll list, right? To be in this index, you need to meet these qualifications. You got to make this much profit. You got to have this much success. You have to meet these metrics. And every index list has its own criteria that the companies have to meet in order to make it on the list and to stay on the list. Because they kick out companies all the time and replace them with new companies. Well, not all the time, but like every so often. Okay, so index fund pretty much now, because there's no active fund manager who's doing all that work and buying and selling and trading and doing all that, the fees go way down. Because now what we're going to do is we're going to pick an index, a list that we like, all the companies on that list, and we like, what that list is looking to do. And we're just going to say, I'm going to go ahead and take all the companies on that list. So I don't need somebody to pick companies, to buy and sell companies, to look at research and analyze. I'm going to go with the companies on that index, on that list. And I chose that index because I like it. So how do you know the difference between active and passive? Great question. Number one obvious way is to read the fund fact sheet or the fund's prospectus. Just kind of like a little technical, a lot of like numbers and words. But if you just look at the description for how the fund is managed, it'll say active management strategy or passive approach. That's the first way. If you don't want to do all of that, you want like a quick, easy way, just look at the expense ratio. If the expense ratio is really close to zero, it's because it's an index fund. If the expense ratio is really high, it's because it's actively managed and they got to charge fees for that person to do all that work. Okay, so that's the easiest way. Expense ratios will tell you. All right, so here's a list of the most famous indexes. Some people say indices, but they're both technically correct. Don't at me, okay? Indexes, indices, same thing. Here's the list of the most famous indexes. And I want you to try to tell me, even if you don't know, try to take like a quick guess, right? How many companies you think are on these index lists? So the Dow Jones is one of the most famous. S&P 500, I think that one's pretty obvious. You already know how many companies in that list. Russell 2000, again, pretty obvious. So those two are easy. And then Vanguard Total Stock Market, which I kind of hinted at it before. So if you were listening, you might already know. But how many companies do you think are listed on these index lists for each of these? So Derek said 30 for the Dow. Nice. That's 100% correct. S&P 500, what about that one? I feel like everybody should be putting the answer in the chat because that one is obvious. And so is the Russell 2000. Nice. Sophia got it first. Mary and Sophia both got it first. 500 companies are on that list. That is correct. And remember, when we were looking at that diversification continuum, that spectrum, one stock, that was really risky. That's not a lot of diversification. 50 companies is okay. 100 is okay. Once you get to more than 100, now you're lowering your risk a lot and really diversifying. So 500 is amazing. 30 is okay, but still not as strong as having the diversification of 500 companies sprinkled all throughout the stock market. All right, what about Russell 2000? Yes, Ashley got it, 2000. And what about Vanguard Total Stock Market? How many companies would you think are in your fund when you buy a one share of the Vanguard Total Stock Market fund? Oh, Ashley said, oh, no, Ashley was out. So Mary says 1,000. It's going to be more than the Russell 2000. Okay, Tyrone said 4,000. So remember before when I said the whole US stock market has over 4,000? That's right. So it's going to be 4,000 plus. It's going to be more than that because there's even more new companies IPO and become publicly tradable. And now you can buy, and then now those are going to be in your fund when you have a total stock market, right? Unlike the S&P 500, just because a company IPOs, remember it has to meet the requirements to be on the S&P 500. It can't just get on that list. The only 500 companies can be on that list versus Vanguard Total Stock Market. The only requirement is that you have to be listed on a stock market exchange in the United States. So it's like a catch-all. Every company in America is in there. All right, so here's the answers. We got them all right. 30, 500, 2,000, and 4,000 plus. So what would be like the difference from the S&P 500 and the Russell 2000? If I open my IRA and I have S&P 500 fund in there versus my friend, she has her IRA open and she puts Russell 2000 in there. What's the difference? Well, every fund has a different goal. So the S&P 500 is known for being large cap companies. Large cap means that the value of that company, when you take the share price of one stock and you multiply by how many shares they have, the value of the total market value of that company is called their market cap or market capitalization, for short, market cap. If it's a large market cap, which means that it's more than $10 billion, then it's going to be eligible to now just meet the first criteria for S&P 500. It still doesn't mean it will get in. It has other things. But in order to be on this list, you have to be large cap. So you have to have more than $10 billion of market cap. So if you take your share price, $1, and multiply it by 1 million shares is outstanding, is available to buy, then that's 1 times 1 million. That's $1 million. You're not going to make it on the S&P 500. You don't even meet the $10 billion market cap. You need to be a really large company. Okay, the Apples, the Facebook or Meta, the Googles, like all those really Amazons are really big companies. And then others, some that are not as crazy, like those are mega cap. Those are like, $1 trillion companies. Some are just like, like Johnson & Johnson or like Bank of America, like they're not that big, but they're over $10 billion. Can I switch from a fund that tracks the Dow to a fund that tracks the S&P at no cost? Not really. You are going to have to pay if you sell your shares of Dow and buy shares of S&P, unless you do it in an IRA. Hey, which we're going to talk about in a second. So if you do it in a brokerage account, which is taxable, every transaction is going to be tied to some kind of tax that you have to pay. When you sell, you got to pay taxes, right? When you get dividends, you got to pay taxes. But if you do it in a tax advantage account, then you don't gotta, then you literally shelter, you pretty much wrap a little ribbon around it that says, oh, this is a special account. No taxes can be put on this account at all, no matter what they do. They can sell, buy, trade all day, every day. They will not get taxed. And we'll talk about that in a second. Mary says, are all the companies on these lists only US based? I believe yes, for every single one here, these are all US based. However, there are other indexes or indices that you can invest in if you want global market exposure. So if you want exposure to European countries or to developing countries, if you want to try to get the Chinese market, if you want to try to get a Brazilian market, right? Then you can actually look for index funds or other funds like ETFs that track a list of companies that are in those countries. And then the other option is, let's say you're like, I kind of just want the whole world. Like, I don't want to just be nationalistic and only invest in American companies. I want the whole world. Then you can get a total world stock market fund, which instead of total stock market, which is the US, total world is every single company that is listed on a stock exchange in the world somewhere will be in your fund. So that's a fun fact. All right, so let's go ahead. The most popular one, which I put the yellow highlighter around it, is the S&P. Let's be real. Whenever people are talking about the stock market, they're talking about the S&P 500. When we say the stock market is up, oh no, the stock market crashed. We're talking about the S&P 500, but we just say the stock market because, I don't know, it's just like a proxy. So for example, if you have a kid in school, right, in high school or middle school, and they have like 8 teachers, 10 teachers, right? Math, ELA, gym, art, science, all their teachers, right? But their homeroom is the teacher that you really know. So when you're talking to your kid, you're just like, oh, so what did your teacher say about your project? The kid has 10 teachers. So they're like, what? teacher you talking about, but you know you're talking about homeroom teacher because that's the main teacher that you know. So when you say what did your teacher think about the project, and your child knows, oh, you're talking about my homeroom teacher. You don't have to say it, right? When we say the stock market, everyone who knows investing knows that you're talking about the S&P 500. You don't have to say it specifically. We all know the stock market means the S&P 500 because the S&P 500 is like pretty much like a way to show how the rest of the market is generally doing. Because remember, those are the large cap companies. Those are the ones that have the biggest market cap in the total stock market. So they move is going to have a big impact on the rest of the market. If they don't move, again, so what they do tends to affect the market way more than a little company going up or down. It's going to have a tiny little, barely effect on the market, right? So these are the ones that really move the market. So let's look at it. S&P 500 is like a really famous index, but people don't know what it is. So this is one of my favorite ways to check out the S&P 500. And if you got kids or you have little cousins or this, I love doing this with kids. I love doing this with teenagers because they can see the S&P 500 like in color right here. They could click on it. They can play with it. This is so cool. So right here on the left-hand side, I got 1 day performance. So that tells me today, this is how the stock market is doing. Well, today's Sunday, the stock market is closed. So it's telling us the last possible data from when the stock market was open, which was Friday. Now, if I click on 1 week, it's going to look different. It's going to tell me how the stock market did over the week, not just the day. I can change it to a year, a month, 6 months. Let's see 6 months ago. Very different versus a year ago. Everything's green, right? Because last year to now, the market has gone up. If you keep seeing in the news, they keep saying the market hit another all-time high. It's just like now it's even better than it ever was before. A new high is like a big deal, but it's happened so many times since COVID that some people are starting to be like, okay, another high. Like it's kind of like a joke, but it really just goes to show that business is booming right now, especially technology. All right, so here's the 1 year performance of the stock market, which means, or the S&P 500. Now, you know that when I say stock market, you know I mean S&P 500. So a year ago to today, if I put this in my IRA, if I put S&P 500 index fund or ETF in my IRA, I could look at this and this would tell me exactly what each company did in the past year that I've been holding that fund in my IRA. So I can see Microsoft did really well, Google, Facebook, I can see all these companies. I can see which ones didn't really do well. Disney, surprisingly, did not do well. And maybe that's because they shut down their parks because of COVID and they weren't really getting the income that they get from Disney World. You know, you could kind of start to think about like, what would be the things that impact these companies during this time? So it's really cool because kids can, they can say like, oh yeah, Disney was kind of closed for a while and then they had to close again. They opened and they closed, and COVID has really made it hard for them with their parks. PayPal, shockingly enough, this past year did not really do that well. And a lot of people were thinking PayPal was kind of in the lead because previous years, PayPal was doing really well. They were one of the first to offer crypto. They, own Venmo. Like there's so many things, right? But when you look at it, they didn't really end up doing so well this past year. Their competitors, Visa, MasterCard, American Express, what's that? Capital One, Discover, Synchrony, and Western Union, much better than PayPal. So you can kind of see when you click on one company, you can see the competitors of that company. Who are they competing against in their little sector, right? So this is the financial and credit services sector. I can see all the companies in that little sector. So if I wanted to have a communication services sector fund, I would have Google or Alphabet, Facebook, which now changed to Meta, Twitter. Like I would have these companies in my match group. I would have those in my fund. Again, that's only 4 companies. So that's a very small number of stocks, which is very risky. I want more. I want as many as possible. So with S&P 500, you have all of these. Green means it's up, right? Red, not so hot. And you can see the little scale on the bottom right corner, which tells you the brighter the red, the worse the losses. The brighter the green, the better the gains. And if it's somewhere in the middle, like gray, that means it's neutral. It's at zero. It didn't make money, it didn't lose money. The stock, at least. I think it's really important at this point just to share that, like, when we say make money or lose money, we're not talking about the company's profits. This is super important. When we're talking about the company did well, a lot of people think when they're new to investing that that's the profit. Like, oh, they sold a lot of, Nike sold a lot of sneakers and they made a lot of stock, they made a lot of profits and their stock went up. That might not be true at all, because the profits of the company is just when they collect all their revenue and they pay all their expenses off, the difference is what they profit. Kind of like us. We make money, we pay our bills, whatever's left, that's our profit, right? But that is not that's not tied to the stock price necessarily directly. They can take some of those profits and pay it out if they want as dividends. Most of the companies on this list do pay dividends, but not all of them. Like about 80% of these companies issue dividends to their shareholders, which means that they'll take their profits and split it up between all the shareholders, and everybody gets like 50 cents or $1 every quarter or every year, right? So you're getting, and the more shares you own, you get that per share. So it's really nice if you have a lot of shares and you get, some cash coming in. But people think if Nike sells sneakers, their stock price goes up. That's not true. If a lot of investors believe that Nike is going to have more value in the future as a company, that their share price is going to go up, then that's when more investors want to buy. And if Nike does something really bad, like they make a bad decision, or I feel like there was a basketball player, I forget his name, that he was in North Carolina playing basketball on TV, and he slid across the court. His Nikes just busted open. If anybody knows his name, put it in the chat. I do not remember that. But that has nothing to do with them selling more sneakers. And that hurt their stock. Nike stock dropped because everybody's looking at this player like, whoa, his sneakers are that cheap? He just slid across the court and his sneakers broke. Like, that doesn't look good for Nike. So their share price dropped. There we go. Zion Williamson. Thank you, Tyrone. So that kind of stuff is negative media attention hurts the share price. The share price is basically what people are willing to pay to own a little piece of that company. And of course, if the company is very profitable this year, it might make more investors be like, oh, they're making money. Maybe they're going to make bank next year too. That could influence the decision, but it's not a direct one-to-one correlation. They make profits, their share price goes up. That's not always the case, right? And I'll give you a classic example, actually. A lot of companies are not making any profits. They're actually losing money every year, bleeding out of their budget, and yet they still have a rising share price. Uber and Lyft, rideshare companies, have never been profitable. Never. Look it up. Uber and Lyft, no profits. Every single year, they lose money. And yet, when they IPO'd, everybody wants to buy their stock. Because if you believe that they're doing something innovative and that in the future they will be profitable and that more people will want their stock, you're buying now thinking about the future value of that stock. So I just want to make that clear, because a lot of people do think, if the company's profitable, then I make money. All right, so now let's go back to expense ratios. Now we're going to transition to IRAs for the last bit, and then I'll take questions. So we talked about the different types of funds. Traditional mutual funds, which come with an active fund manager that charges hefty fees, can range from 0.8% all the way up to sometimes 2%. In this case, the average right now historically has been 0.8 to 1%. So the average is getting lower and lower. Why? Because there's competition. There's a new kid in town. Index funds were literally just, were like a thing of the 80s and 90s. This is not something that was around very long. So when you have an index fund and you're paying 0.04 on average, 0.1 compared to 1, that's, we're literally talking about 8 to 10 times as much in fees that you're paying to have an active manager move your money around. And in the research shows that doesn't even make you more money. Most of the time, it actually, you make more with the index. So, because you pay less fees and you just ride it out. So when index funds came out and they lowered those fees, a lot of investors started flooding to index funds. And actually on my birthday in 2019, so August of 2019, there was an article in the Wall Street Journal that said that for the first time in history, more money was invested in index funds than all mutual funds that were actively managed. So that was a huge shift. And that was like revolutionary. I was like, wow, made history. The fact that now more people know about index funds and there's more money in index funds now than in active managed, which was never the case before 2019. So when you see expense ratio in your brain, that's the annual fee. So I got to subtract that from what I expect the returns are going to be. And that's when I get my actual performance. So now you know why we're investing money. We're trying to access shares of funds in the stock market or companies in the stock market through an account that allows us access to the stock market so we can grow our money. And specifically in this session, we're talking about doing that for retirement. We want to retire. So what happens when you make money in the stock market? You get taxed, right? Like I said, investments and taxes, they're like café con leche. They're married, right? You can't separate them. So when you make profits in your investments, you have to pay taxes. There's 2 tax brackets on capital gains, which is what the profits that you make, earnings that you make from investments are considered capital gains. They're not considered earned income. So they don't get taxed with your income tax bracket, they get taxed capital gains tax. So there's two brackets. There's the short term, and then there's a long term. Long term means that you held that for more than a year before selling. Short term means you bought it and then you sold it before a year went by. So you were impatient. You didn't even hold it for a year. Come on. So that government doesn't want you to do that. They want to encourage us to hold our investments for more than a year. So what they do is they make the taxes higher if you do short term. So in that case, you see here, the tax brackets are exactly the same as your income tax bracket. So even though you're making capital gains, you're paying income tax brackets, which is much higher. So by looking at the difference, you can see if you make, let's say, $45,000 a year, you're in the 22% income tax bracket if you're filing single. But if you hold your investments for more than a year and you make $45,000, you can save 7% on taxes. It's almost a 10% decrease in what you pay to the IRS because you're now in the 15% bracket since you make $45,000 single. Now, long-term capital gains puts you at 15%. Now, the cool thing is, especially for young people, if you have kids out there, if you have little cousins, little brothers, a son, a daughter, listen, most kids who are working as teenagers, they're not making $40,000. A lot of adults are not even making $40,000. If you're making minimum wage out here, if you're in your 20s and 30s and you're not yet making more than $40,000 a year, you will hold your investments for more than a year and pay 0% in taxes as long as you hold your investments for more than a year before selling. So you can literally buy investments, hold them for more than a year, and pay nothing on taxes, only if you're single when you file taxes and you make less than $40,400, or you're married filing jointly making less than $80,800 combined, or you're head of household making less than $54,000. So these specific tax filing status, that's how you know if you can pay 0%, or if you get a decrease in taxes based on how long you hold. Now, this is really annoying. You got to do the calculation. How much am I going to pay on taxes? Am I going to owe the IRS money when I make? The easiest way to avoid all of that is to use pre-tax accounts, which are another word for it is tax deferred. That means that you can put off all that tax drama until you retire. You got to worry about none of the taxes. Again, like I said before, you could buy and sell, trade all you want. You will not be taxed because it's in a tax deferred account, which means the taxes won't come until you take the money out at retirement. Now, these generally pre-tax accounts are going to include a traditional IRA, not a Roth IRA, traditional IRA, a 401k or 403b at work, or 457 or other types of retirement plans, or a TDA or anything like that. Health savings account, which is for short called an HSA, which is for medical purposes, and you can you can write it off on your taxes and get a deduction, so it's pre-tax. 529s for your kids to go to college, that's also pre-tax because you get a deduction when you file your taxes. So anytime you see the word Roth, that's a sign to you that you know that it's after tax. It's not pre-tax, it's not tax deferred, okay? It's the opposite of pre-tax. It's money that you're investing after you've already paid taxes on it. So this is where we get into account types. And this is now where we really look at IRAs, because the number one reason why you want to start investing is to build money so that you can retire with dignity. And the different types of retirement accounts that exist, the ones that you can open by yourself without a job offering it to you, having an employer, or even if you're self-employed, is an individual retirement account. Anybody with earned income can open it. And depending on what your situation is, you might choose the Roth or you might choose the traditional. There's other types of accounts here, but again, we're focusing on IRAs, right? So we talked, the whole first session that we just focused on was all talking about cash, stocks, bonds, mutual funds, index fund target. These are investments that you can choose from. We focused on mutual funds, index funds, and ETFs are also like indexed. So very similar to the index fund conversation is ETFs, except they're just taxed differently and they have better tax advantages and they're cheaper to get started with. So I kind of actually prefer ETFs. But either way, those are all funds that you can buy shares of in an account. So everything we just talked about before, like picking an S&P 500 index fund or a Russell 2000 index fund or a total stock market, you can't buy that unless you have an account. So the types of accounts that exist, general taxable brokerage is usually the one people talk about when they're talking about paying taxes on capital gains. But if you open an IRA, again, you putting that tax deferred bow on top, they can't touch you. So you can put your index funds or ETFs, buy shares of those in your IRA, and not have to worry about taxes at all, at least until you withdraw the money in retirement. So here are the main differences between, I put the 401k, 403b in there just in case, but really we're focusing on Roth IRA and traditional IRA. So the annual limit right now is up to $6,000. If you're over 50, you get a catch up. You can put an extra $1,000. I don't know why it says extra 7,000. That is not correct. So I need to correct that. But it is basically an extra $1,000 in your Roth IRA that you can put in. So instead of 6, it would be 7,000. Oh, that's why I see what it said. I didn't put extra 7. It's like total 7. Sorry. So it's up to $6,000, but if you're over 50, up to 7,000. Okay, that's for both Roth traditional, which means you don't get to put 6,000 in one and 6,000 in the other. The total cumulative combined total cannot be more than 6,000 per year or 7,000 if you're over 50. So that means you can put 3,000 in each. You could put 1,000 in this one, 5,000 in that one, whatever combination of numbers that adds up to 6,000. But a lot of people think, oh, I'm gonna open a Roth IRA and put 6,000. Then I'm gonna open a traditional IRA and put 6,000. No, that will put you over the maximum of 6,000 total, and you will owe penalty taxes to the IRS. So you don't want to do that. Total has to be 6,000. Contributions, again, that's the deposits, the money you put in. They're pre-tax in a retirement plan through your job. They're pre-tax through a traditional IRA, but after tax with the Roth IRA. Now for this one, you see next to pre-tax is a little asterisk. That's because a lot of people go like, but it's not pre-tax though, because when I use money from my paycheck, it's my paycheck. You can see that I pay taxes on my money and then I put it in my traditional IRA. So it's after tax money. Yes, technically when you put it in, it's after tax. But then when you file taxes, they deduct that amount that you put into the traditional IRA off of your taxable income. So it reverts back as if it was not taxed. So they kind of like flip it and reverse it. They just make it go back to pre-tax. So even though you put in after tax money when you fund the account, the tax deduction makes it go back to pre-tax. That's how the traditional IRA works. Now, the Roth IRA is after tax. When it comes to taking the money out, you have to wait until you're 59 and a half. And at that point, with the 401k, with the traditional IRA, you have to pay taxes because you got the deduction, which means you didn't pay taxes. It was pre-tax. So now you have to pay those taxes. So you're going to pay it when you take the money out, and you're going to pay it at the income tax bracket that you're at in retirement when you take the money out. Roth IRA, not taxable. I'm going to say that again. Roth IRA, not taxable. You will owe 0 taxes if you use a Roth IRA. And that is the beauty, because the way that it's taxed is what makes a Roth IRA so unique. Now, there's a 5-year rule on it. So you have to be 59 and a half to take all the money out, and you have to have had the account open for 5 years. So if you open the account and put $10 in, 5 years later, you turn 59 and a half, great. You can take any profit, you can take the money out. But if you open the account when you're 58 years old, you don't meet that 5-year rule, even though you're 59 and a half. You have to wait 5 years after your 58th birthday because you waited to 58 to open the account. So we got to catch people early so that they open it early, young, and start investing early and often, because then that 5-year rule is not a problem, okay, to take the money out. Admin, so who administrates the account? Who administers the account? Is it the employer? Is it you? With the 401k, it's the employer. But with Roth IRA and traditional IRA, you make all the calls. You make the choices. You decide who, where, which brokerage you're going to open it. You decide how much money you're going to put. You decide what index ETFs, what funds you're going to buy or stocks. You decide. Now, there's a lot more choices with the individual IRA, with the IRA versus your workplace plan. If you have a 401k, they're going to tell you what companies, they're going to tell you, what you can and can't do, how much the fees, all that. You only have a limited set of choices that they provide, but not with IRAs. You literally, the sky's the limit. You choose where you want to go, what you want to buy. Withdrawals, you have to wait till you're 59 and a half. This is the number one reason why people don't like IRAs. They're like, why would I wait till I'm 59 and a half? It's like, okay, listen. You can actually take out any deposits that you put in, the contributions that you put into a Roth IRA, you can take them out anytime, no taxes, no penalties. What you can't touch is the earnings, the profit. So if you put in $6,000 every year for 3 years and it grows to, 35,000, you can take up to 18,000 of that with no problem. So it's a beautiful gift because it's like, oh, it's kind of like extra savings on top of my savings account if I need to. I'm not going to try to rely on it, but if I needed to, I know that legally I can take anything I put into a Roth IRA back out because I already pay taxes on it. I just can't touch the profits. But that's not true for your 401k. That's not true for an IRA. It's locked into your 59.5 unless there's a what's called a qualified expense, which you can go on the IRS website and look and see what are all the reasons why you can take money out without having a penalty. COVID, there was like a emergency plan. People could take money out without a penalty. You could take money out to transfer for your home purchase. There's a lot of things, but it's not like I can just take money out and go shopping or take money out and go to Miami. That's not how that works. Except with the Roth IRA, you can, but you shouldn't. You shouldn't do that. All right. And the last thing is required minimum distributions. So when you turn 70.5 or 72, if you're born after 49, which is most people, that is going to be the year that you have to start taking money out of your 401k and your traditional IRA, whether you want to or not. Legally, you have to start taking money. And there's a calculation the IRS will provide when you file your taxes to make sure you have to take that and pay taxes on it. With a Roth IRA, there is no required minimum distribution age. So if you open the Roth IRA and you put a lot of money in it and you end up using real estate or your business or your 401k in retirement, and you're like, guess I don't even need that Roth IRA. I had it. It's got a lot of money in it, but I'm living off of my real estate, my business, and my 401k, and I'm good. I don't need. You don't have to touch it, and you can use it as a wealth building tool because you can pass it down to your children or anybody in the next generation by listing them as a beneficiary, and they won't have to pay no taxes on all the money in your Roth IRA. This is how we can use the Roth IRA to make it a wealth creation tool. No required minimum distributions means you can die and that Roth IRA will be passed on to the next generation with all that money with no taxes. That's amazing. It's a huge, huge, huge deal. I kind of wish my dad and my mom had Roth IRAs now because I'm like, come on now, that would have been amazing. You could pass it down to me. Now I don't have to pay taxes on that. All right, so should you max out contributions to the Roth IRA before you max out the contributions to a 401k? I would say it depends if you have a company match. If your 401k at your job gives you a match, try to hit that match. Try to get that free money. And then once you meet that full match, go to the Roth IRA, max that out. And if you still have extra money, then go back to the 401k and add more, or just open a taxable brokerage account, but know that you're going to be paying taxes on that. And that's not going to be tax sheltered with the pretty bow the way your 401k and a Roth IRA will be. So just know that, but try to get a match. If there's no match, you may go to the Roth IRA first, max it out just because it is going to give you more control over what you buy. And then you may go to the 401k. So that's a personal choice. Employer doesn't match, there you go. So you got a choice. You can max out that 6,000, and if you have extra money to invest, sign up for the 401k. Totally up to you. All right, y'all, it's that time. 20 minutes are left, and I want to answer any and all questions. We've been through a lot here. And I actually want to give you, I'm going to send a couple email links and a follow-up. One of them is, if I'm not sure to choose between a Roth and a traditional, here's what you can do. You can scroll down to this calculator, and I'll put the link in the chat. I'm also going to share all these links in the email, the follow-up email, because I want you to have all of it. You go down here, you put the tax year. The cool thing is you have until the tax day of filing to put money into an IRA for the previous tax year. So even though it's 2022 right now, if you have not put money in a 2021 IRA, you can open a 2021 IRA today and fund it. And then the next day, open a 2022 IRA and fund it. So you can put $12,000, or if you're over 50, $14,000 all at once for 2021 and 2022, but you have to do the 2021 account before April 15th. So make sure, or this year, I think it's April 18th, before the tax filing deadline for the previous tax year, for this next year. So let's say I'm opening a 2021 tax year IRA. My filing status is single. Do I participate in a retirement plan at work? Yes. Modified adjusted gross income. So after my deductions and all that, if I do a quick calculation, you can also pull up a calculator to do that, but you can also roughly estimate. So let's say my income is like $100,000 and my tax bracket generally is going to be like 20-30%. I'm going to go ahead and put $70,000 in here. And am I 50 by December 31st of 2021? No. I'm going to hit calculate. It's going to tell me right now, based on my income and what I said for my tax filing status, I could put $6,000 in a Roth IRA, boom, right away. I can also use an IRA and get a tax deduction for $3,600 that I can write off to lower my taxable income. So that $70,000 would drop to $66,400. The non-deductible will be the amount that I cannot write off on my taxes, right? Because my income is a little higher than the threshold to get a full deduction. So in this case, I would go to that Roth IRA better, because I'm only going to be able to tax deductible $3,000. That's really not going to be that big of a difference on my taxes. And I'd rather get the full $6,000 and lock it into the Roth IRA and get those tax-free gains. So that's how I would think about it. Now, if you were doing something different, like married filing jointly, no, yes, this can really change your situation depending on how you file your taxes. So it's super important that you do this in a way that kind of matches your situation. There we go. So you would recalculate and it would tell you for you and for your spouse. So all that kind of stuff really helps. It just helps you know, like, what should I do? So for 2021, if you make $200,000, if you got rich people problems, then you don't have a retirement plan at work because you're self-employed and you are 50 or older by the end of the year, you can recalculate. You are not eligible for a Roth IRA anymore because your income is too high. You can put $7,000 and get a tax deduction on your traditional IRA. Now, the trick here is you have to remember that there's also another rule. If you wanted to go to the Roth IRA, you could do a backdoor Roth IRA. So you can't contribute to the Roth IRA, but you can convert into it. So you could put $7,000 into a tax deductible traditional IRA, and then the next day, once the money goes through, convert it to a Roth IRA, and you still get into the Roth IRA without contributing to it because you convert it. That's why it's called going through the back door. Like, you put it in the traditional and then you convert it and still get into a Roth. So that's also an option as well. All right, y'all, I've been talking a lot. What questions do we have? Let's see. Question in the chat, which I'm going to answer right now. Which one is the best brokerage? I promised I was going to address that. Here are 3 of the most highly respected personal finance blogs that I love to go to. I research articles on here. I read all kinds of stuff on here. I'm going to open all 3 of them and just do a quick glance. NerdWallet's 14 best IRA accounts for January. What do they have on here? Fidelity, Wealthfront, E-Trade. What else do they got on here? Charles Schwab, Ally. Okay, that's a couple from NerdWallet. Now let's look at the balance. Best IRA accounts for 2022. Fidelity, Schwab, TD, Vanguard, Betterment. Okay, so far, just off these 2, I heard Fidelity, Schwab, and Vanguard come up twice. Now I'm gonna go to the third source, Bankrate, and let's see what they say. For 2022, they say Schwab, they say Wealthfront, Fidelity. So if I go with any of those, I'm good, okay? And I wanna tell people, this is not the kind of decision that needs to make or break your opening the account. Literally, if the company is on all 3 of these best IRA lists, you're good. Don't spend more than an hour on this decision or even 20 minutes, because the reality is this decision doesn't really matter. The decision that matters is what type of account you open, traditional versus Roth. Roth is always my preferred if you can go that route. And the funds that you're buying have to have low expense ratios, right? We talked about that. That eats away at your profits. Those are the decisions that really matter, not which brokerage, right? Just go with one that is very well respected, that comes up again and again on all the best of lists. It's respected in the industry, full service brokerage, that's great. And then you go ahead and decide, what are the funds that I want? All right, let's see comments in the chat. What else we got over here? Do you think a Roth IRA is a better investment approach than a brokerage account? This is if your goal is to save for retirement and emergencies. I do, because when you put money in a brokerage account, it's taxable. Your profits, you're going to have to pay tax on them in the year that you got. If it's dividends are taxed in the year that they were paid out. And if it's a sale, you're going to have to pay the year that you made a sale, that you traded. So you're going to be paying taxes and dealing with that tax headache. With a Roth IRA, the money you put in plus any profits you make are all tax free. And that's huge. And you still have that contribution amount that you put in that you can dip into early before 59.5. If something comes up that is an emergency that you need to dip in a little early, you got that leeway with the Roth IRA. So I would say, yes, if it's for retirement, start with the Roth IRA, get to that $6,000 max, and then go to a traditional or like a taxable brokerage, regular, like standard brokerage account. But get that $6,000 in there first, because it makes a big difference. What happens to a Roth account if there is a market crash? Great question. Depends on what you put into that account. So let's go through a quick example where you have, here's the slide that I wanted to talk about that with. So if you have S&P 500, your asset allocation, which is really a quick pro tip, is what are you putting your money into? You would have 100% stocks if you had S&P 500, because remember, that's 500 of the large cap stocks in America. So all the stuff in your account is S&P 500, then you have 100% stocks. What they say you should do is break down your asset allocation based on how far away your goal is to take that money out. So if you know you're 30 years away from retirement, you got time. You can have 100% stocks, you're fine, right? But if you're gonna retire in 5 years from now, you should not have S&P 500 index fund only in your retirement account, because if in 5 years you need the money and the market crashes like it did in 2020 or 2008, your account balance is going to drop exactly what the S&P 500 drops. So you need to now throw in some bonds. In the same way you can find like S&P 500, let me see. Let me go into a quick S&P 500 index fund at Fidelity. Let's say you invested in Fidelity, you have your account, your IRA, as just as an example, and you Google S&P 500 index fund at Fidelity. Boom, here we go. The ticker symbol for that is FXAIX. So when you go to buy it in your Fidelity account, you're going to type in FXAIX and you're going to buy shares, however many shares you can afford. Look at the price to see how much it costs and how much you can afford. So you want to look at that. Those are really important, for you to know. So right here, you have the expense ratio, 0.015, so low, amazing. That's going to be super important for you to know, right? If you want to buy it, you can log into your account and buy shares, and you can see the return for the past 10 years has been really great. 5 years, really great. 1 year, really great, right? Because it's just tracking the S&P. It's not really doing anything fancy. It's got the S&P 500 companies in there. Now, if you want to buy one share, it's going to be $161. So if you're putting in $1,600, you can buy 10 shares. Great. Like, that's amazing, right? Now, if the stock market doesn't do well, all your money's in here. Versus if you go in here and you type in a bond fund, USA bond fund, the same way you can get a fund that has all stocks from the US, you can get one that has all bonds from the US. And the beautiful thing about that is that bond funds are going to allow you to really, even if the stock market goes really bad, the bonds generally are always going to stay between like 1 and like 5%. So you kind of know you're locking in a really low growth rate, but it's not going to go below 0 with bonds, generally speaking. Sometimes, like in a really great crash, like in 08, we saw them go below 0, but that was very rare. So even if the market does crash, if you have corporate bonds and treasury bonds, you fixed a rate there. It's a loan, it's not a stock. So what you did was you lend money to a corporation or you lend money to the government, and they promised to pay you back a fixed interest rate for the next, 10 years, 20 years, 30 years. If you got a 10-year bond or 20-year bonds, or if you got 30-year bonds, then even if the stock market goes negative 20%, you locked in a 20-year, 3% bond, you're making 3% every year for the next 20 years, no matter what happens with the stock market. So as you get closer to needing the money, you start selling shares of your S&P 500, of your total stock market, of your Russell 2000, whatever your index or your ETFs say you have that are stocks, and you start moving that money to more bond funds so that it can kind of carry you through even if the market crashes. So if you're close to retirement and the market crashes, you shouldn't really feel it very much. You'll see maybe a little drop, but you won't feel it as much as somebody with all stocks. And if you do feel it a lot, it's because you didn't change your allocation and adjust it. Now, one easy way that people remember this is to do 125 minus your age. So if I'm 125, if I do 125 minus my age right now, I'm 32 years old. That's going to be 93, which means 93% of my IRA should be stocks and 7% should be bonds, the bond fund. The 93% should be stocks. And interestingly enough, right now, I'm a little bit more aggressive than that. So I like to do 100% of my IRA is stocks right now. And I do Vanguard Total Stock Market. Like I'm just full disclosure, that's what I do. Not that that's advice, but that's what I do. So as I get a little older, when I'm 45 years old and I'm closer to retirement, if I do 125 minus 45, now 80% of my IRA should be stocks, and the other 20% should be bonds, because that way I'm protecting my money a little better. And when I'm like in the thick of retirement, I'm 65, a lot less. Most of my 50-50 kind of, it's closer to like 50-50. So my portfolio is not really going to feel that real hit of just the stock market. And some people who are a little more conservative, they like to use 110 110 minus their age. So 45% would be stocks at 65 years old. So if you're a little more conservative, you like really want to protect your money, you don't really want to take any risk, do 110 minus your age. And so me right now, I would have 78% stocks instead of 93% stocks if I was more conservative. But since I'm more on the aggressive side, I have a little more. But you can always tweak it from there. Should you be debt-free before opening an IRA? Absolutely not. You do not need to be debt-free, especially if you have low interest rate debt. For me, I had credit card debt, which was so high. It was like 26% interest on my credit cards. What's the point of me trying to get 9% in the stock market when I'm bleeding out 26% on credit card interest? There, I would say focus on the credit card, try to get it to a manageable amount, and then you can start really pouring into an IRA. But if you have student loans that are growing at 5-6%, listen, anything that's like less than 7%, 8%, which is again, like what you can expect from the stock market, you can just set that on auto pay or put a little more if you can, and really try your best to get as close to the maximum, because once 2020 is over and April 15, 2021 passed, you can never go back to put $6,000 in that 2020 Roth. This year, when April 18, 2022 passes, we can never go back and put $6,000 in that Roth IRA for 2021. So it's a locked, limited time only deal that you have with the government to put in this money now and let it grow with no taxes. But you have a deal with the credit card or with your student loan company that you can pay whenever. So I would always say to people, if you have manageable interest rates that are pretty low, lower than the average of the stock market, then do both. Pay your minimum payments, put a little extra if you can, and invest, because the investments are going to grow, and the earlier you start, the better it is. Your money's going to grow so much more. Can multiple IRAs be open? Yes, they can, but that is going to, for you, like if you have 2 IRAs, that's just going to be a little annoying. I prefer to just combine them and just have everything in one IRA because it's really annoying. But I have right now a traditional IRA and a Roth IRA. And this year I put in $6,000 into my traditional IRA and then immediately converted it to a Roth IRA because my income was too high to qualify to go directly to the Roth IRA. So I did the backdoor Roth. If you want to open an IRA for your child, I highly recommend you do it. Actually, in the follow-up email, I'm going to be sending you a link to an article that is why your kid needs an IRA. The only thing about this is that your kid needs to have earned income. So if you have a teenage kid who works at Old Navy, or who works at summer camp, they qualify. They can open a Roth IRA and put money in. But if you have a kid that has no earned income, they're in school, they're not working, then they can't qualify. So any working kids earning income, this article is for you. If you have kids in your life that have some kind of income, even if it's a little bit, even if they're selling bracelets, even if they're mowing the lawn, babysitting, even if they, make money on a YouTube channel, whatever, that earned income qualifies them to put it into a Roth IRA. If their income is less than $6,000, then they can only put up to their income. And that's true for adults as well. Like if I made $3,500 this year, period, that was my whole income, then I can't put $6,000 in the Roth IRA because the government is like, how you put $6,000, but you only made $3,500? Where did that extra money come from? What are you doing? So you can only put what you earn if it's less than $6,000. But if you make more than $6,000 or you make $6,000, then you can go ahead and max it out. My job's 401k offers an option to contribute Roth designated money. What is the difference between that and a Roth IRA? Amazing question. So we're gonna go back to that chart where I showed the difference between, and I'm gonna share these slides so you guys will be able to go through them via email and the recording as well. This chart will show you that the difference between your 401k, you can put up to $20,500 in your company's Roth 401k, but you can only put $6,000 in a Roth IRA. That's number one difference. So for me, with my job, I have a Roth 401k and I put $20,500. You better believe that every single check I divided it because I get 24 paychecks in a year. So I took the $20,500 and divided it by 24 paychecks. And that's about $854. So every time I get paid, it hurts me so much when I look at my pay stub and I see that they took $854 from my paycheck. But I know that it's doing me, my future self, a huge service because she's going to have $20,500 compounding for all of, the next, 20 years or something. So what was the calculator? I'll show you real quick. So say I'm putting $6,000 in my Roth IRA. Every year I'm adding another $6,000 and I'm leaving it there for 20 years. And the stock market continues to grow somewhere between 7 and 10. I'm going to put 8% just as a safe guess. And I hit calculate. I'm going to have over $300,000 in 20 years. Now, most people work, 30-year career from when they're 20 to 65. That's 45 years, right? Most people, but you have to start at 20. Most people wait to start until they're later. The earlier you start, the better. So if I did this for 45 years, I would have over $2.5 million. Like, this is how you create wealth. You start really early and you just keep putting a little piece of every check. And this is just my $6,000 Roth IRA. Now imagine if I maxed out my $20,500 account at work, and every year I put another $20,500, and I leave it for, let's say, 10 years. Maybe I'm not with my company that much longer, maybe 10 years. I still get that same over close to $500,000 in just 10 years, rather than waiting 20 years and putting 6,000 every year. So I can get to my goals faster the more money I invest. And that's the beauty of it. If I stay with my company 20 years, boom, $1 million, right? Like the more money you put, the quicker you're going to grow to meet your goal. So if I'm doing this at work, then maybe I don't need to max out my Roth IRA. Maybe I just need to put 3,000 in my Roth IRA because I know that I'm putting 20,500. But everybody can't max out their 401k. It's a lot of money. And I'm very blessed to have a job and a side hustle that pay me well enough to be able to do this. When I was 23, 24, 25, 26, and 27 years old, I couldn't max out anything. I was just maxing out my credit cards. I was a mess. So it took me so much time to really get the discipline to budget and save and invest so that I could cut spending and do all these things and get more mature and prioritize investing. Where did you get that formula from? The 125 minus, that's just a classic age-based asset allocation rule. If you Google age-based asset allocation, you'll see lots of different people's formulas. They have all these different ways that they do it, but the classic one is 110 or 125 minus your age. That's just like a rule of thumb. But you can read about asset allocation rules. Lots of different people have a lot. So it used to be 100 minus your age. And then as people started living longer, like we don't die at like 60, 70, 80 anymore. Now we're living to like 90 to even 100. A lot of people are living to 100 now. So the formula changed a little to adjust for that. All right, so open the IRA, then put your money in. Oh, great. You know what, Ariana, you just took me to that last slide that I was about to share before. Here's the steps. You got it right there. Choose the brokerage. Open the IRA on their website, link it to your bank account so that your IRA can literally just get funds from your bank account, whether that's a checking account or a savings account. Just link it the same way you link your checking account to Venmo. You just link it right in the account. Then you transfer the money. Once the accounts are linked, you transfer however much money you want to start with, and you select the IRA that you want to invest in. Then the money is going to go in. That's going to take like 2 days, sometimes 3 days, just for the money to go from your bank to this investment account, the IRA. That does not mean you're done, because all you've done is put the money in the IRA. But the last step is the most important, which is to use the money now that went through and cleared and transferred to buy the shares of the investments that you want to own. You actually have to buy the Vanguard Total Stock Market Index Fund shares, or the S&P 500 Index Fidelity Fund, or the Russell 2000 ETF. Whatever the thing is that you decided you want to own, you need to buy shares of that investment with the money. You can't just transfer the money and be like, all right, I put $5,000 in my IRA, woohoo. Did you buy shares of the investments with the money after the money went through? That is super important, because what happens if you just park the money, it'll just sit in what's called a money market fund, which is literally a glorified savings account. It's just bonds. So it's growing somewhere between 1% and 4%. That's not going to get you the wealth that you think it's going to get. So you need to buy the shares of the investments after. So it might be buying like a few shares of an index fund that has stocks in it. And then maybe you also buy some bonds as well, depending on your allocation, right? If you're a little older and you're closer to retirement, or if you're young and you want to retire early, you might be trying to retire in 5 years, even if you're 40. Like, it doesn't matter your age. It matters when do you want to take that money out. And then that generally tells you how much bonds versus stocks you should have. All right, it's 1 o'clock, y'all. If you need to exit, you feel free to exit. Thank you so much for joining. I'm sticking around for the chat and chill, and I will also just keep answering questions. So if you got some time, I'll be here for a little while. I'm so grateful to you for supporting me, for showing up today. I cannot tell you enough how happy I am to be able to take all this knowledge that I have gained over the years and spit it out onto this webinar so that you have it. I hope you took a lot of notes. And if you need to go back and go through the slides or watch the recording again, just keep an eye on your email. In the next hour, you're going to get the recording and the slides, and they will be yours forever and ever. So you can refer back to it. You can review it with your hubby, with your kids, with your wifey, with your anybody and everybody can review it with you now that you have the knowledge and access to the information. All right, let's go through and see if there's anything else. Do you do consulting if I want to talk to you one-on-one? Oh, you're welcome. You're so welcome. If you want to do one-on-one, absolutely. You can go on my website and book a one-on-one with me, and just fill out the form so I know exactly what you want to talk about with me. And the fee is $150. We'll do a full hour. If you need extra time, we can always run over. But yes, we can do more kind of personalized educational coaching. But the 6K doesn't have to be all at once. No, it doesn't, Ariana. That's the beautiful thing about this. You can do it little by little. So what I used to do when I was real broke, I was just put $50 every month. I was like, I'm doing the best I can. Okay. I'm doing what I can with what I got. So I would put $50 every single week or every single month. And I didn't really max it out at first. In 2015, I opened my IRA, but I didn't max it out. I think I got to like $2,800 by the end of the year, but it's what I could do at that time. And that's fine. When I can max it out, then I can max it out. You can put 500 a month, but if you can't do that yet, start where you are, 50, 100, whatever you can. Please include a link to the article. Absolutely, that will be in the follow-up email. It absolutely will. I love that article. Can you open a Roth IRA right now online? Yes, you can. Just pick a brokerage. Literally go on here, look at one that you like, open it up. I went with my niece to the Charles Schwab website, and we tried to open her custodial Roth IRA because she's under 18, or she was at that time. And Charles Schwab had a weird rule where you have to fill out the paperwork and mail it to them. So she didn't really want to do that. And so then we ended up going to Fidelity's website. We opened her Roth IRA. The next day or two, she got an email saying everything was set up, everything was good. We linked it to her bank account. She transferred in $3,000. And then the next 2 or 3 days later, we got on Zoom again. And we talked about everything I talked to you about today. And she then decided that she wanted to invest in the S&P 500 index fund with Vanguard through the Fidelity account. And I was like, okay, now let's compare the fees. So then she looked at the Vanguard stock market index fund with Fidelity and the Fidelity index fund, and Fidelity's index fund was cheaper because they're going to charge you more to get a different company's funds when they have a competing product, like buy Fidelity's fund in the Fidelity account. So she ended up changing her mind. Instead of going to Vanguard total stock market, she got Fidelity's fund, which was a 0% expense ratio. So she's doing all the things I wish I did when I was 18. I'll tell you that much. The April deadline is for the 2021 Roth IRA. Can I open one today and put 3,000? Yes, you can. You can put 3,000 right now, up to 6,000 if you have it for the 2021 Roth IRA, as long as you do it before April. And then you can open another one for 2022 at any time. You don't have to rush to the 2022 one because you have till April 2023 to open the 2022 one, and you have till April of this year to open the 2021 account. You're amazing. Thank you. Thank you. Oh, I'm so happy I had so many people from all over today. This made me so happy. All right. Any other questions? Or if not, just unmute and ask. I feel like I kind of went through most of them, but unmute if I didn't get to your question and just ask me. And also, I would just love to chat with you guys. Any questions that I didn't get to? Don't be shy, y'all. Feel free to unmute.
I actually have a question. My name is Stanley.
Go ahead. Hey, Stanley, what's up?
I was wondering, is VTI a great stock to buy for index fund?
Yeah, so VTI is actually an ETF. It is an index because it tracks the total stock market, but it does it through an ETF instead of an index fund. So an index fund is a mutual fund, which means that when you buy or sell shares of it, you're buying it from the mutual fund company. And then when you sell it, you're selling it back to the mutual fund company, right? Which is where the mutual fund manager works, right? But if you get an ETF, these are traded on the exchange, just like a stock. So that's why it's called ETF, exchange traded fund. So instead of buying and selling from the mutual fund company, nope, you buy and sell from another investor on the stock market who's exchanging and trading just like you on the stock exchange. So that means you can buy and sell it anytime, versus an index fund or a mutual fund, you can only buy and sell once a day. So it's kind of annoying. Oh no, what happened? Oops, sorry, y'all, my internet went a little crazy. So sorry, so you can only buy or sell a mutual fund and index fund once a day, but you can buy and sell anytime all day with an ETF. And so yes, what I would say is look at what it's tracking. What is it catching on the list? This is Vanguard total stock market. So you're going with Vanguard, which is honestly the best because they created the index fund. The Jack Bogle, who was the creator of Vanguard, his company is actually the first one to ever offer an index fund. Nobody wanted to do that because why would they do that? They're making all this money from charging 2% for actively managed funds. So why would they now bring a passive and lower the fees and stop making commissions? Like, they didn't want to do that, but he did it because he was like, it's the right thing to do. We should let people keep their hard-earned money, especially average everyday working Americans. Like, why is the financial industry like literally just taking their hard-earned money right off their backs? So he did the right thing, even though he could have been a multi-billionaire when he died. He died with a lot less. He's still very, very rich, but he could have been way more wealthy if he never did this. So anyway, he did the right thing. We love him. Rest in peace, Jack Bogle. He's amazing. Vanguard is great. They're the creator of the index fund. And what this is an ETF that allows you to get shares of every single company in the total stock market. And it's administered by Vanguard. And instead of an index or mutual fund, you're getting an ETF of it. So it's much cheaper. And so what you can actually do is, go and type in Vanguard VTI fact sheet. This is where you can see all the details of it. So let's see, VTI fact sheet, bam, here it is. So I'm gonna scroll down and look at the expense ratio. Woohoo, 0.03. So close to zero, amazing. And if you look at, is there a minimum amount that you need to buy to get in? For ETFs, there's no minimum except the price of one share. You have to be able to buy one share, unless you're going with a fractional share, which you can do through certain companies. But if you want to go straight in your brokerage and buy a share, you have to be able to afford one share of VTI. So right now, if you just Google share price VTI, you'll see like how much it costs right now, $235. So if you got that, bam, you buy one share, and you have more, you can buy more shares. Now, the difference between that and VTSAX, which is the Vanguard Total Stock Market Index Fund, not ETF, is that in order to buy this, you have to have, let's do the fact sheet for VTSAX. Here it is. If you look at it, the expense ratio is a little higher. So instead of 0.03, it's 0.04, so a little more. And you need a minimum investment of $3,000. So if you don't have $3,000, you cannot own VTSAX, the index fund, through Vanguard. You need $3,000 to start. But they give you a little note here that says, well, if you don't got $3,000 right now to start with, you can get an ETF of this exact same investment for way less. So that's why I like ETFs. They're cheaper. You can buy and sell them anytime if you want to, which you really shouldn't be buying and selling, but it's nice to know you can. And the taxes are a little bit more beneficial because you don't have to pay taxes constantly when other people sell shares back to the mutual fund, because it's not a mutual fund, it's an ETF. So when you sell, it's the only time you really have to pay taxes. Are target date funds good? Ooh, this is a great question. Target date funds are awesome for people that really want to be extra lazy and they don't mind paying a little bit more. So when you look at, even for example, a Vanguard target date fund, the year is the year that you plan to retire. So let me use like 2055 as an example. You want to look at that, hit fact sheet. Again, every time you want to see all the details, just type in fact sheet for the name of the thing that you're researching and you'll find everything you need. So here's the Vanguard Target 2055 sheet. Here's the fact sheet. You can download the fact sheet. In this case, let's just scroll through and look. So when we're looking at the cost, so I can't find it right here. Let me hit expense ratio. I just search. So I'm going to have to open up the fact sheet then. All right, open up the fact sheet and I'm going to hit expense ratio. Where is it? Where's the expense ratio? Oh, there it is, expense ratio, 0.15. So instead of paying 0.03 or 0.04, you're paying 0.15. So you're paying like a little more, which, it's kind of annoying. Like that's a little bit more than 3 times more money, but you never have to sell shares of your fund to buy shares of bond funds. They automatically do it for you. So remember how we said the 110 minus your age or 125 minus your age? You don't got to do that. They do it automatically based on the year 2055. So they go backwards from that year. And every time you get closer to that year, they get more bonds and get rid of the stocks. So as you get older and closer to 2055, by the time you get to 2055 and you go to retire, you will have mostly bonds in there. So even if the stock market crashes, you won't feel it. So that's the good thing about a target date fund, but it comes at a higher cost. So if you don't mind just doing it yourself, you'll save 3 times the money by getting a 0.04 or 0.03 index fund or ETF, and then just logging in every few years and doing 110 minus your age and just getting rid of some stock and buying some bonds. It takes 15 minutes, but some people just don't want to do it. So target date funds are great if you don't want to do it. If you want to be a little lazy and you rather just have them do all the work for you. So Rainier said, I have one and it's doing really badly. Look at what you're investing in, because that target date 2055 fund, it depends who is that fund with and what are they investing in. So this target date fund 2055, it will tell you exactly what's in it. So it says right here, the fund's bond holdings are a diversified mix of short, intermediate, and long-term US government bonds and some corporate bonds. And for the stock market, the underlying funds are Vanguard Total Stock Market Index Fund. Oh, that's great. That's an index fund that I would buy myself if I was doing it myself. So that's good, right? But if you have one that's investing in something else that you don't really know what it is, you're going to have to do some research to see why it's not performing so well. Because if you do Vanguard Total Stock Market or S&P 500, you should be doing really well. 2021 stock market did 23.1%. So you should be seeing those gains in your account. If you don't see it, you might need to change the target date fund that you have. These are great questions. You're welcome. All right, y'all. What did I not cover that you're curious about, or anything else besides this? Because this is chat and chill time. So we can do other topics if you want as well. Oh, I had a resource that I wanted to share. If you're curious about the stock returns since like 1928 and bond returns and S&P 500 returns, check this out. This is like for my real nerdy nerds. It has all of the returns for the past returns since 1928, I think. It's like a chart from NYU. Every time I go on online and I'm like looking at returns, I look at this. So if you scroll back all the way to 1928, you're going to see a lot of negatives during the Great Depression. Of course, the stock market really didn't do well. The worst thing that ever happened was negative 43%. Ouch. Imagine you were retiring in 1931 and your investment account just dropped by pretty much half, like almost 50% is gone. You have like a panic attack. But that's why you're not supposed to have all stocks when you retire. You're supposed to have all the bonds. And that year, look at what happened with the 3-month treasury bill bonds, 2%. You would have been fine if you had 3-month T-bills. Negative 2% instead of negative 43%. You would not have lost nearly as much as if you went with just Federal Reserve US Treasury bonds. And if you went with corporate bonds, you would have lost a little bit of money, but not as much as the stock market. So at the end of the day, bonds allow you to like balance out your portfolio and take less risk, because bonds are a lot more secure and steady versus stocks that go up and down like crazy. Let's look at 2021. So 2021, pre all of the, like before any inflation and anything like that, it was 28.47%. But as you know, 2020, or maybe you don't know, if y'all haven't been looking at the news, check it out. Inflation has been at an all-time high. So in 2021, inflation was 7%. So when you look at that number, you have to subtract 7%, because the inflation is going to really eat away at the value of that money that you grew. So take away 7% from that and you get 21.4. So that's why a lot of people are saying the stock market went up 21, 22, and 3%, depending on dividends. If you collected dividends, it might be a little more. And if you reinvested the dividends, and then also depending on your fees as well. So if you were paying 2% fees, you're going to make less than somebody who was paying 0.01, right? Or 0.04. And then you see the bond market, you would have got less than 1%. But if you're in a position where you're retiring next year in 2023, it doesn't matter. You're going to look at this and be like, oh man, I should have stayed in the stock market and made 28%. No, you shouldn't have. No, you shouldn't have, because just like it made 28, it could have made negative 28. So don't ever go back and look at it like, oh, I could have, should have, would have. No, what you did is the smartest thing based on when you're retiring. So if you're retiring in 2023, doesn't matter that the stock market did amazing last year. You are about to retire. You couldn't take the risk if it went down. So you need to make sure you lock in that 0.1, 0.06, that 1%, and just get, whatever the bonds are offering, which could be 10%, 11% in 2020, or 1% pretty much, depending on what type of bonds you picked. Corporate bonds, treasury bonds, 3-month bonds, or long-term bonds. What's the best investment option for retirement for someone who's 52? Or what are the most important factors we need to consider when creating a strategy? So for somebody who is already 52, what age do they want to retire? Like completely stop working, because that's what's going to tell you how much time they have. And you're going to go back to the money chimp thing, and you're going to go, okay, if they put it in an S&P 500 index fund and the stock market continues to do 8% for the next 10 years, then they can retire at 62 in 10 years. So let's say they max out their Roth IRA. They're 52, so they can put an extra $1,000, holla. So instead of 6,000, 7,000. So put 7,000 in that IRA every year if they can afford to, which, you know, again, everybody cannot always afford to do it, but if you can, do it. Let it grow for 10 years, which is until they turn 62. If it averages 8%, which is very realistic, it might even be a little higher, then they will have over $120,000. Now, I'm not saying that's going to be everything they need to be comfortable in retirement. We know that that's not, but that's way better than not having anything, than having $10,000 or $20,000 in the bank, or $5,000 in the bank. Like a lot of people, when my dad retired, he had $5,000 in a savings account at the bank. He has a mortgage. He has 9 kids. Well, most of us are self-sufficient, but still, he got a wife. He got some kids that are under 18. He got things he needs to handle. $5,000 in the bank, and you now have to continue to make money. He basically was driving a taxi for money and side hustling because he couldn't stop working. And Social Security was only giving him like $800 a month, which is not even enough to pay the mortgage. So we have to consider, like, every bit of money we can get, let's try to go for that. Now, 52 is a little close to retirement age, but given that they still have 10 years of time left, I would say max out that Roth IRA, get 7,000 every year if you can, and really go for, a little bit more aggressive at the beginning. And then as they get 4, 3, 2, 1 year away from really needing to dip in the money, that's when you're going to start to do like closer to like 50-50, where you start bringing in some bond funds into like US total bond market and US total stock market. Those could be the two funds. 50% of your money goes to US total stock market fund, and the other half of your money, 50%, goes to US total bond market fund. And you got bonds and stocks all in the US in your portfolio, 50-50. So either way, you at least have the guarantee that half of that money is always going to be sitting there, and the other half is going up and down with the market, but it still has a chance to grow as you start pulling money out in retirement. Because the thing is, the money doesn't stop growing just because you retired. Like, it keeps growing. Actually, I have a really good calculator that I did. Let me see if I can find it. IRA. Let me see if I can find it. If not, I'll just have to share it later. But I made up a calculator. There it is. Here it is. So, and I'll share this in the follow-up email as well. So you can make a copy of this calculator and see what would happen to you if you start investing in an IRA this year. So let's say in your case, the person is 52. I'm going to change the age for 2021. They can still put $7,000 for 2021. So if you act now, right? And if you have the money saved. So let's put 51 years old last year. It's going to automatically change all of it. If it changes to green, that means that the amount you can invest is actually 7,000. If it was 21 right here, it would not be green because you can only put 6,000, and it would change the 6 to 6,000. So it automatically does it for you. So I'm going to put 51 here last year, 52 this year. If you invest $7,000 every year, in 2030, when they turn 60, they're going to have $115,000 if the stock market does 9%. If the stock market does 9.5%, they'll have a little more than that, right? If the stock market does less than 7%, 7%, you'll see they'll still have 100,000, but it'll be a little bit less money. So you can play around with different calculations. If the market does really, a little bit better than average, or if the market does a little bit worse than average, and you can see different scenarios. But the point is, this should be your goal, to invest every single year, and then you can start to see what will happen if the market does that well, given your age. So at 65, they'll have $200,000, which is great. Listen, I don't know very many people in my community that have ever had $100,000 cash, like, period, right? So let's at least try to get 6 figures for our people. But the real goal should actually be, almost close to $1 million by the time you retire, because the reality is the cost of living is going up, inflation is going up. A lot of things are going to eat away at some of that money. So you want to really have as much close to $1 million so that you don't have to worry about anything for the next 25 years, 30 years, 40 years of your retirement, depending on how long you live and what age you choose to stop working. Now, if you only have 200,000, you're going to leave that money to keep growing, and you can work part-time. I would much rather be 64 years old working a part-time job than be 64 years old working full-time just because I have to. So even having 200,000 might not seem like it's going to be the everything that you need, but it'll allow you to get some of your time back. You can work part-time and spend time with your family, right? Can we have your calculator? Absolutely. All of this, anything that I showed you today is going to come to you in an email, but I'll drop it in the chat. You just need to make a copy of it because you have view only access. You can't edit it. So you would need to go to file, make a copy, and make your own copy and save it. And then you can start editing and manipulating the data. Now, if you live to be 95 years old, they'll have $3 million at that age if they don't touch the account, which is not realistic, right? Because when they turn 65, they're going to start dipping into it. So that's not necessarily realistic, but it gives you an idea of the potential to let that money grow. And if you pass away and pass that Roth IRA down to your family, imagine passing down $2.9 million to your daughter, to your son, to your grandbabies. Like, can I get $2.9 million, please? Like, that's amazing. And just the fact that all you did was open a Roth IRA and put a couple $100 every month in it. Like, it's amazing. All right, y'all. What other questions do you have? Anything else? We still have a good group of people here. So feel free to unmute. Tell me if you like this, if you have other questions, if you felt like there's something missing that you're really curious about. I can always add more resources to the email, or just unmute and tell me how you're doing, where you're at. You guys are shy.
Well, it's Stan again. I'm just gonna say I appreciate all the information that you provided us. It definitely helped out a lot this workshop, just understanding, and the material they're gonna email to us. I'm gonna definitely take a look at that. Keep reading it, keep understanding it more and more, because it's true. My family are immigrants as well, and they came here to New Jersey, and yep. I'm a first generation. So I'm just trying to break that chain, break that pattern, and just try to just increase my chances, because during my 20s, I didn't really take money seriously. I was just partying. I was just doing dumb things. But now I'm in my early 30s, and I'm 33. So I'm just trying to change that, trying to budget, trying to learn all of that. So I'm appreciative of all this information you provided us. Thank you.
That's amazing. Stanley, do you have an IRA yet?
No, I don't. No, okay. I don't as of right now.
When are you going to open your IRA? Because you know how now. You know exactly what to do.
Well, what I was going to do was I was going to sit down with you and try to see for that 1 hour, just try to see what can I do? Because currently I am going back to school, trying to get my bachelor's at this age. So I'm just trying to go back. I'm trying to learn the material, trying to learn all of that in that field of business and finance. And yeah, so as of right now, I don't have an IRA, no. So I'm definitely trying to learn more from what you're providing us with the information you're giving.
Okay, so I'm gonna give you a challenge, a homework assignment. Open one before you go to sleep tonight, because it's free to open and you don't even have to put money in it. Okay. So before you go to sleep tonight, open one. I don't care if it's with Fidelity, if it's with Vanguard, if it's with Schwab, if it's with whoever. Pick one of the top ones, open the IRA for 2021 and just leave it there. And when we meet to talk one-on-one, you will already have the account open. So now all we got to do is talk about transferring money and making decisions in the account, but you will have it open. That is literally it's such a weight off your shoulders to go to sleep tonight knowing I have an IRA open. I opened my account. It's open. And that is going to feel amazing. It costs you $0. It's going to take you about 10-15 minutes. I promise you're going to feel so accomplished tonight. And then definitely, we'll follow up and do whatever we got to do if you need one-on-one and stuff. But what I'm going to do is in about 10 days, I'm going to send everybody who attended tonight an email, and I'm going to follow up. It's been 10 days. If you have not opened an IRA yet, what is holding you back? Because you got everything you needed to know to do it in the webinar. Something must be holding you back. Let me know what it is so I can help you kind of get through that barrier, because the research shows usually within a week or two after a conference, if you don't take action, you're not going to take action. So I want to make sure everybody really does, at the very least, just open the IRA. That's an easy first step.
Will do. Thank you.
Yes, you're welcome. Ashley's taking that assignment. Crystal's taking that assignment. Yes. Listen, it's not weird if you email me or you slide in my DMs and you're like, okay, I did my homework. I opened my IRA. I chose this brokerage and I opened this type of IRA, and just do it, because every time you have an accountability buddy, it makes everything feel like you're not alone. I have somebody, I don't know, I've never met her, but so what? I'm sliding in her DMs and we're talking about this. So it makes me feel, I have a coach, I can feel a little bit better that I'm doing the right thing, that I'm taking the right steps, and that what I'm doing is in the right direction. Sometimes when you go clicking around and you don't really know if it's right, and you so do not feel hesitation to email me, text me. You can DM me, slide in my DMs. I'm not putting on my cell phone number, then I'll get a million text messages a day, but slide in my DM or email me, and I promise I will like engage, answer questions, just cheer you on, because it makes a big difference in these little goals. Yes, Darnisha's taking that homework challenge as well. And I'm going to email to everybody. Here's your challenge. In 10 days, I'm going to send you a follow-up email. And I'm going to ask you, did you open the IRA? Tell me where you chose to invest it. If you didn't, I need to know why. What is holding you back? Because if you don't open it by now, you ain't going to open it. So let's get it done. Let's make it happen.
Hi, Nelly. It's Sophia
Hi.
from the Bay.
Hey, Sophia.
Good to see you again.
Yeah.
Okay, so I hope everyone can be my accountability buddy here too. So I have a good friend, Jaime, and he has been trying to get me to open my Roth IRA since like a year ago. And I've just been too chicken. I don't know why. Like, I'm just like, that sounds like a big step, a big commitment. And so this was so helpful. And I'm so glad that I could do this, because I feel like now I have more information and I just feel a lot more empowered to be like, to make this next step. So I just want to say thank you. And I'm going to open it. I'm going to make my man's open one. He has like, like we have 401k, thankfully, at our jobs and stuff, but like, I'm like, no, we got to get this. We got to get our Roth IRA going.
That's right.
I'm a dog mom now, so I got to, build wealth for my children.
That's right. Listen, they need as much love and support as babies do. Sometimes they need stitches. Sometimes they need medical. Listen, food, all that stuff.
He's got insurance. He has health insurance. I'm like, he's already has a better life than I do.
See, you're taking care of him. He can take care of you too. Come on, girl.
Yeah, he's got pet insurance. He's in the whale, just kidding. But no, so I just really appreciate you and your knowledge and your time and energy, because this is, it's hard out here for us first gen, and not even if we're not first gen, like it's just hard out here, like trying to figure out this, because it's so overwhelming. Like all of this is kind of intimidating sometimes, but you're empowering me. I'm sure you're empowering everyone here to like, so just
I love it. Thank you, sweetie. I'm so glad you joined. I saw you in the Bay not too long ago, but I'm like, just seeing you here, I'm like, oh, it makes me so happy. But no, you got this. Like, the scariest thing is just doing it. Like one of the things, like, honestly, if it were me and I had like the rest of the day today off, this is what I would do. As soon as you get off the Zoom, I would go online, just literally the brokers that comes to mind. If it's Fidelity, if it's Schwab, whatever, go to their website, go to Fidelity, go to Schwab, whatever it is, and just open the account, because it doesn't take a long time to do it. Like, I think that the problem is that people think it's going to take a long time. Like, if you go here, look, open an account. Like, individual brokerage or retirement, guess what? You know the answer. Traditional or Roth IRA, guess what? You know the answer. You know the answers because you came to this workshop. So you click Roth IRA. Guess what? They're just going to ask you for all your personal information to make sure that you're not doing any kind of fraud. So you're going to go, I'm new to Schwab. I don't have no ID. Okay, boom, put everything in here. It's like opening a freaking Facebook page, or like creating a TikTok account. Like, it takes the same amount of time. It shouldn't be something that scares you, and so you literally go here, you put all your information, all of this, date of birth, all that, and you answer some security questions next, and you just go through like a few more screens. Guess what? There'll be like your account features, terms and conditions of the account, funding it. You can link it and not fund it. You can just open it. And then guess what? Your account is open today. That's it. At least it's like, I have an IRA now. It took me 10 minutes. Like, and to me, I think a lot of people just need to like actually see it to believe it, that it really is that easy, and feel confident that they do know the answers. When they ask you a question, you're going to know the answer. And if you don't, literally DM me or email me like, hey, I'm opening my account and they asked me if it's for 2021 or 2022. What is the answer again? And then I'll ask you, well, do you want to put it before April for last year, or do you want to put it in for this year that you have till next year in April? Oh, yeah, let me go ahead and do it for last year. Okay, so click 2021 contribution. And that's it, right? Like, these little kind of bumps in the road, you iron them out, and then boom, you're done. So to me, it's giving you confidence, it's giving you the knowledge, and then just being here to cheerlead for you guys. Because for me, the hardest part was just starting, and I didn't think I had enough money. But you don't even need money to open it. And then if you can put 20 bucks every week or a month, start with that. And then you increase it as you get more money. And one of the things you said is, oh, I'm putting money into my 401k, which is amazing. But again, go back to that compound interest calculator, because the math is really important. They always say that you need 25 times the income that you want in retirement. So if you want to live a $60,000 lifestyle in retirement, you're going to need 25 times 60,000, which is $1.5 million. So your goal is going to try to be to have a combination of 1.5 million with your 401k and your IRA together. So if your 401k is like, I make $60,000 a year and I'm putting 10%, then that means 6,000 is going in. So same as an IRA. So if you're putting 6,000 in your 401k and another 6,000 in your IRA every year, you're putting in $12,000 a year. And if you keep maxing both of those, or putting 6,000 in your 401k, putting 10%, and doing the IRA, you can do this calculation. In 25 years, how much am I going to have if the market does 7%? Whoa, that's really close to $1 million. Okay, what if it's 8%? Will I get to my million? Yes, I'm not at 1.5, but maybe that means I don't live a $60,000 lifestyle. Maybe I live a $55,000 lifestyle, right? Which is very similar. It just means maybe saving a little on groceries, right? Like making some subtle changes in my lifestyle. That's the kind of thinking we got to do. We got to go to retirement, pick that number we're trying to reach for, close to $1 million or $1 million or a little more if you want to, above average lifestyle in retirement, and then backwards plan. How much do I have to put in every year? If you want to hit 1.5, then you got to put more than 6,000 in your workplace retirement plan. So you're putting 6,000 in your Roth IRA, 10% of your $60,000 salary is 6,000. Maybe you put 12%. So then you're like, okay, I'm going to do the math. 12% of my $60,000 salary is 7,200. So if I add 7,200 from my 401k every year, plus the 6,000 that I'm doing for my Roth. So now we're getting to 7,200. Now I'm going to add 6 to that. So I'm going to be 13,200 every year. And I'm going to do the same thing every year. Just put 12% of my pay into my 401k and 6,000 in the Roth IRA. Then I'm getting super close, right? And so now you can see like, all right, maybe it means I'm retiring in 30 years from now. With my 1.7 million, hell yeah, I'll be able to do a little bit more than $60,000 a year without having to work for that. That's amazing. Like, so to me, it's just a matter of having the confidence to know what are the numbers and how do I get there? My 401k is giving me this, but usually it's not enough. And also my 401k is locked until I'm 59 and a half, but my Roth IRA, I can tap that 6,000 contribution in 5 to 10, 15 years if I need to, with even if I'm not 59 and a half, and have that safety net of extra cash with no taxes and no penalties, which I can't do in my 401k. So it just gives us these options that allow us to have more flexibility and sleep better at night, knowing we got money in a lot of different places. When we need it, it's going to be there. Yeah, so that's another way to play around with the calculator. I'll make sure to include that in the follow-up as well, because I didn't model that with the whole group, but that is super important, just to be like, all right, I know I need my 1.5 mil because I'm trying to spend this much every year, times by 25, like get my basic numbers, and then I can go backwards from there. And if my 401k is not going to get me there, that's how I know I'm going to need my IRA. Y'all are amazing. These were some great questions. Oh, another thing I'm going to do, I'm going to take all the questions from the chat box and answer them in a document and attach the document to the email, so that everything that was asked in the chat, if you ask something in the chat and it didn't get answered, it will be in the document. So everybody has that there too, because I know it's for me. I like to go back through notes and like do my little study session and then know that everything is there. Woohoo! Ashley said, I'm gonna open my Roth IRA today. Yes, birthday's coming up. That's your birthday gift to yourself. I love it. Love it, love it, love it. Yes, Stanley's opening a Schwab account. I got people messaging me, I'm opening a Fidelity account today. Yes, amazing. Go, go, go. This is literally like just the stuff that we should be bragging about, like when I get on my calls with my girlfriends, I don't want to hear, oh, I met this cute guy. I want to hear, oh, I opened my IRA today. Yes, girl. Yeah. That's what I want to hear. Oh my goodness. Y'all are amazing. I love these comments. Yes, Mallory, ever true. I didn't even realize we had some Brown alum in here. I love, if you are a Brown alum, thank you so much for supporting me. I actually just went back and did a webinar just like this one for the Brown University Latino Alumni Council. And I cannot tell you, like, the number of people's comments that were like, I never learned this. No one ever told me any of this. Not my school, not my family, and going to an Ivy League school, you would think, oh, you get the best education. We don't get any financial education. It's criminal. So just, empowering everybody with this information. It's like the least I can do after like having it all in my brain. I just want to I want to put it all out there and make sure that you take action and do this too. Because too many of us are, if we don't take action, going to end up repeating negative cycles. And we do not need to do that. It's very easy to break the cycle with a couple $100 a month. And I know we spend that on Ubers and groceries, don't lie. So let's just repurpose that money. Thank you, Stanley. And thanks for your questions and your comments. Sophia, thank you also for sharing your comments. I really appreciate y'all taking the time today. Instead of going to church, you came to Money Church. Thank you. Thank you for showing up to Money Church on this Sunday. I even did my hair pretty and everything for y'all. I was getting all messed up, but I gave you my Money Sunday church look with my hoops, of course. Accountability buddies, follow each other on IG. Yes, please put your IGs in the chat. Follow each other. I love that idea.
I have one quick question. So yeah, I know I asked about children and open an IRA for them. I have a 2-year-old niece, and I'm kind of like, if I pay her for chores, quote unquote, right? Does that count into her earning income to where she can have her own IRA?
Yes, it does. As long as you have a record keeping to prove to the IRS that you did pay for those chores. Now, if they're 2 years old, it's going to be kind of hard for you to justify to the IRS that you had a 2-year-old doing chores. So you probably want to pick something different. Like if they're 6 or 7, they can do chores, right? But if they're like 2, maybe it's something different. Like one of my friends actually did this. She has a baby who's like not even 2 yet, like 18 months or something, and took pictures of the baby, went on snapfish.com and ordered a bunch of calendars and little mugs with the baby's pictures for like January, February, March, all the way through December. So the calendar had like all the pictures of the baby, paid that baby $6,000 for that photo shoot for their modeling contract, put the $6,000 in the custodial Roth IRA for that baby. Now, if we go back, okay, as long as you got the paperwork, you have a self spreadsheet and you put how much you paid them and everything, you can do that, right? If you make, I think if the baby, you would have to file taxes on that income because it's over the threshold. But then when you file taxes, there's a standard deduction that's $12,550, which brings your taxable income to 0. So if you file, you're not paying any taxes anyway. There's no impact on the taxes for anybody making less than $12,000 because they raised that standard deduction a couple years ago to super high. So anybody making less than 12 grand basically can put money in an IRA for free with no tax. You know what I mean? So what that means is that baby at 18 months has $6,000 there. And if it grows for 18 years, let's say she doesn't even add anything. She just did it one time. She doesn't even add any money. She just leaves that there for 18 years. And the stock market does pretty well, 8%. That baby gonna have $23,000 at the age of 18, just because they did a little photo shoot for some calendar one time when they were 18 months. And their parent was, intelligent enough to say, if I do this now, if I can get the 6,000 now all at one shot and let it grow, right? But we're like, oh, well, what if I get audited? Okay, give the IRS your spreadsheet, show them the payments, show them the day and the time the photo shoot happened, show them that the payment went into the child's savings account. So you need to open a savings account in the child's name. Make sure you do it the right way so that the IRS comes sniffing around. You're like, I ain't do nothing illegal. The tax code says as long as the child earned the income, they can invest it. The child earned the income. It's literally that simple. It's just a matter of having proof. Don't have like your grandma Venmo you $6,000 and then you put it into the account for the baby and then IRS is sniffing around like, wait, where's the $6,000? How did they earn it? But you don't have proof. You didn't do it the right way. You had grandma Venmo you and then you put it into a Fidelity account. You didn't cover your bases. Just do it the right way. Open a savings account for the baby. Put the money in there. Mark it as mark the day and the time of the photo shoot. Put a little invoice together, Google like invoice template, and the baby's going to invoice you. You're going to pay the invoice into the baby's savings account and you keep those records. And that's it. It's actually that simple. So that would be like babies that are really, really small. But if they're like teenagers, they get a W-2 or a 1099 if they work. So they'll have that. And then you don't have to worry about bookkeeping.
Great. Thank you. Thank you so much. What if you have family that's like across seas, for instance? Not in the country?
Yeah, that's going to be trickier because in the US, you need to have either a social security number or an individual tax identification number in order to invest. So if you have an ITIN, that means that you might not have a social security number, but you're here paying taxes in this country, which allows you access to this country's stock market. Now, if you're in another country, you're not going to be able to prove that you're here paying taxes. So you won't be able to access investment accounts in the US. You would have to open an investment account from your country if they have, you know, a stock market. Most countries do have some kind of stock market. And then you can invest in US investments through that account. And the taxes kind of get a little complicated because the US is going to keep some of the taxes that you have to pay on your earnings. And then the country that you are investing in is also going to look at it and then be like, okay, we're going to let you write off the taxes that you pay to the US because they don't want to double tax you. So the taxes can get a little complicated, but it's nothing crazy. Everything comes out on the forms. So for the most part, if you want to access the US stock market, you either have to do it here or you have to do it through a brokerage account in your home country if it's a foreign country, and then just kind of deal with the taxes.
Gotcha. Thank you so much. I can't wait to have a consult with you, and we'll talk again soon. Thank you.
Okay, you're welcome, Danisha. Thanks. I'm so glad you were here. I'm so glad to have you. All right, so that's how you turn $6,000 into $23,000 for a baby. I didn't really think about showing that, but that's huge, right? Like, and for this, it would have to be a custodial Roth IRA, because a Roth IRA is for anybody who's over 18 that earns income. If you're under 18, you can't open it on your own. You're going to need a custodian. So that would be why it's called a custodial Roth IRA, because the custodian, like me, is opening it for the primary account holder, which is my niece. She's 17. As soon as she turns 18, she's the primary account holder. I have no claims to that money, no access to it. I was just her custodian, kind of like, you know, just accompanying her to help her get access to the account, but I don't have any rights to it. It's all her money. It should be earned by her, and I'm just helping facilitate the process of investing. Yay, Sophia Torres on IG. We got Lavish Love Ash. If you are on Instagram, put it in the chat, follow each other. And I would love to, even if we have like a little chat group, I would love to hold each other accountable, because any way that you can, know that there's somebody checking for you. Did you do it? Did you do what you say you were going to do? How's it going? It always helps us just to be a little more successful. All right, you all. I think that's all we got. If there's anything else, let me know. But otherwise, just check your email in a little while. I'm going to send out the slides, the recording, and the Q&A doc with a few other resource articles and stuff, that links that I would say, like, 10, 15 minute read, and it's so worth your time. Like opening a Roth for your kid and all that kind of stuff is in those additional resources. And yeah, any spreadsheets or anything that I shared, I'll also put in there as well. So you have everything in one place. I got Derek's IG as well. Anybody else, put your IGs there. I'm gonna follow all of y'all. Don't act like you don't know me when I follow you. All right, y'all. Thank you so much for joining. And again, keep an eye on that email. And in 10 days, you're gonna get another email from me, and I'm gonna ask you for your receipts. What did you do? If you didn't do anything, why not? How can I help you get over the hump? Okay, so just keep an eye for both of those from me. And in the meantime, just stay in touch via Insta. Yes, stay healthy, get wealthy, peace, joy, happiness, all that stuff. New year, new energy. So this is a great time to jump on that new year energy and open the account and start getting things done that you normally would put off. But this new year, new energy is definitely going to help. So jump on that. Yeah, get your receipts, y'all. Get your receipts ready. All right, you all have a great rest of your Sunday and amazing Martin Luther King weekend, as well as, short week at work if you're working. And I'll see you all next time.